requires automatically under the law that by leaving money to that child, if it helps them to exceed the estate tax exemption amount, I'm basically losing 40% of it when the kids die, or forcing them to do all kinds of planning we wouldn't otherwise have to do. So very, very important to understand that this gives us tax protections under the law and asset protection because the access by the beneficiary is controlled by somebody else, by the trust via the language that's in that trust. In some cases, even the beneficiary is the trustee. That might seem silly to you to think that my surviving spouse is the trustee of the trust, and there's language in there that says you can only take money out for these reasons. Obviously, she's the one that controls the judgment that goes along with that. But that's a critical difference in the law. In the position that she's acting as beneficiary, she's powerless. In the position of trustee, she's powerful, armed with the language that's in the trust. And in the law, those are two distinct roles. The role of the beneficiary, basically for estate tax purposes, is to say, does the beneficiary have control of the underlying assets? If the answer to that is no, then the assets are not includable in their estate. So this is critical when you're talking about the difference between, let's say, the spouse in a bypass trust versus the spouse in a marital type of trust. Critical stuff there. Also, asset protection aspects of it. If I can only get money for certain reasons and somebody attacks that beneficiary, they can't reach through the trust and take money out of the trust. It doesn't belong to the beneficiary. It belongs to the original grantor left in this irrevocable trust arrangement to the trustee. And some people are concerned as part of that asset protection to provide some divorce protection, right? If I leave money to my kids, there's a 50% divorce rate, and the kids end up getting divorced, maybe they lose half the inheritance that was left to them. That's a concern to a lot of families. Certainly tax law change protections by subjecting the assets to tax when they go into a non-marital trust. We realize that we've now crossed that transfer tax bridge. We can also sometimes layer it with generations giving transfer tax exemption and get multiple generations worth of protection out of that arrangement. Since we have created an irrevocable transfer, that transfer is basically an ex post facto transaction. Changes that take place after that in the law should not affect that trust. So for transfer tax purposes, very, very important to understand that we're protecting ourselves against what might happen in the future from a tax law standpoint. And certainly the more people you know, the more important you know that pets are. And that many people, in fact, create trusts for the benefit of their pets for the rest of their lives or for other philanthropic causes that they care about. Right, leaving their values down to other people. And again, I'm going to meter out based on those trusts, usually in a less discretionary fashion, but I can use things like trusts or private foundations or donor-advised funds or all kinds of vehicles to have somebody as a power holder decide when and how and to what charities money would place out. Or I can say pay all income on an annual basis to charity. However I want to structure those arrangements. We have a wide ability to decide how we choose to control the legacy that we're leaving to whomever or to whatever cause we're leaving those assets. Very, very important. So in dynastic trusts, as we've talked about, you can layer this with generations giving transfer tax exemption. And for as long as it goes, for a spouse, child, grandchild, great-grandchild, et cetera, if I'm in a state where I can go forever, right, there's a number of states that do that, including South Dakota, where there's no rule against perpetuities. Most states have a rule against perpetuities, and you'll have to chop this off at some point down the road, 100, 120 years out, based on the family structure. But basically, as long as I can keep the irrevocable trust on one side of the line, and the beneficiaries on the other side of the line legally, right, we get those tax protections and asset protection features. So it's not just one generation down. It's not just for the spouse. It's not just for the kids. It can go on and provide those benefits on an ongoing basis. This is why you see a trend in the trust business towards long-term irrevocable trusts. Now, again, if the language is is such that all the money can be distributed to beneficiaries if they need it, then it may, in fact, end at the child's generation. Child gets into financial straits, and there you go. There's the safety net. There's the backup, exactly what I intended to do with the trust assets. Very, very important to understand the connections between those pieces, and that it doesn't make the money unavailable to the child. It just says if the child doesn't need all of the money, then keep it going down through the generations. Again, tax protected and asset protected as it does that. So there is a Uniform Power of Appointment Act, and that Uniform Power of Appointment Act defines certain kinds of things that are good for us to know as just general terms. It applies specifically in your state only if your state has adopted that act. But power appointment basically means where you have a power holder, right, somebody who has some power given to them in the document, acting in a non-fiduciary capacity to designate a recipient of an ownership interest or another power appointment over the appointive property, right? Fancy ways of saying it means that the power holder, the person who's given a power under the document, has the right to either take the money to themselves or do something else with it, right? They're going to appoint it to themselves or appoint it to somebody else. Kind of an odd word for us to use in regular English, but it makes a lot of sense in the legal sense, right? It's the power to give or take or use the property that's in the trust. It doesn't include a power of attorney. Don't get those two terms mixed up, right? That's a whole separate power that gives me signature authority over somebody else. It's simply a distribution right to property that is in an irrevocable trust, right? That's what we're going for. So general power of appointment is what the IRS means when they say power of appointment, and they mean that basically makes you the owner of the underlying property, right? General power of appointment means power exercisable in favor of the power holder, right, themselves. If I can appoint the money to myself, that is a general power. To my estate, to my creditors, or to the creditors of my estate. Again, it seems like odd language, but that comes directly out of the Internal Revenue Code. So those are the four guidelines that the code gives us. If I have the power to appoint to myself or to my estate, which basically means I can change the beneficiaries to whoever I want, right? That gives me the power to control that property, and in the IRS's terms would make me the owner of that power to the extent of the power, and at the time that the power is valid, I am treated as the owner of that underlying property. That's the key principle to understand behind powers of appointments. But of course, the code made an exception. Okay, they made one exception in the code directly. And so that's a non-general power appointment, what we very commonly in the business call a limited power of appointment. Okay, so a limited power appointment or a non-general power of appointment is one that does not meet that standard above. There was only one exception crafted in the code, but we figured out another way to get around this as well, basically using these four things. That's why the law is so important, right? Lawyers are going to go in there, they're going to parse through the law. They're going to find the best ways to take advantage of the legal system as it is. And most importantly, we need to understand where the lines are, right? Where is that bright line test that we can say, this is on one side of the line, that's on the other side of the line? Where is it very clear that the law tells us this is okay and not okay? So this is just a little summary chart of what I'm about to talk about, because if it's new to you, it's relatively a lot of content and it gets into detail. These are all recorded, so you can come back and watch anytime you want to. I'll repeat this same slide later on in the materials once we've talked about it, but I just want to give you a little foreshadowing of my quantification system that goes into this area. So in the general powers appointment, remember this is to yourself, your estate, your creditors of your estate. By the way, it's or. So just the power to appoint to myself makes it a general power. So this is where you're treated as the owner of the underlying property to the extent of the power and at the time that the power is available to you. Okay, so there's basically three ways that this is done. The code doesn't separate between lifetime and testamentary. If you just watch your sound.
I can listen now. What do you need?
Natalie, if you could mute your line, please. So we've got lifetime and testamentary general power appointments. This is just simply because attorneys will draft this in different ways to be able to have a power that's available during somebody's lifetime as opposed to at that person's death, right? The code doesn't distinguish. It's a general power either way. Power to appoint to myself would be a lifetime power. Obviously, a power to appoint to my estate generally is a testamentary power, right? One that's only good at my death, exercisable in my last will and testament. And a 5x5 power is also defined in the code. It's basically just a mini-me version of the lifetime general power appointment. It is a 5% general power of appointment. I can appoint 5% of the money, right? They actually do it in dollars as well, $5,000 or 5%. Obviously at 5%, that'd be a $100,000 trust, and hopefully you're not dealing with funds that are that small. But from a practical standpoint, the 5x5 power is simply a type of lifetime general power of appointment, but very often drafted as a separate clause to give more flexibility by the attorney for the beneficiary based on the objectives of the settlor and what it is they're trying to accomplish for their beneficiaries. So really, if you can just remember those three things, lifetime general power, testamentary general power, and 5x5 power, that's all the general powers that there are. Now, I can create other similar powers, crummy powers or other kinds of things that didn't fall into that perfect description. I just know that it's a power to appoint to myself and there's no restrictions on it. Therefore, it's a general power of appointment. The limited powers on the other side, there's one that we use all the time. It is probably the most commonly used power of appointment because this is the one that gives the beneficiaries access to the money that's in the trust without treating them as being an owner of the trust. Here's what the code basically said. It said, if you have the right to appoint the money to yourself, but it's limited by what they call an ascertainable standard, and then they use an example of that, such as health, education, maintenance, and support, then it's not a general power. Okay, the code says that very specifically. It is an exception to the rule. So they don't have to use those words, health, education, support, and maintenance, but the attorneys do all the time because it's directly in the code. So you know you're safe. There's other terms in the regulations that also say that. You'll see language like my custom manner of living or other kinds of things. Anytime the trustee has discretion to do that, you have that power. It also can be created not just by language, but by using, let's say, an adverse party. Adverse in their financial interest inside the trust. So if, for instance, I said my surviving spouse can get any amount of money that she wants for any reason whatsoever, right? That sounds like a general power, doesn't it? As long as, so now I'm making it limited, as long as our daughter approves, okay? And let's say that the trust goes for my wife's life and then down to our daughter. So the daughter's interest is adverse to the spouses. In other words, if the spouse is wasting the money, the daughter's probably going to go, no, Mom, you need to take out money to do that. Right? Now, that can create a lot of tension in families, but it is a way to be able to cure that problem. What a lot of people do instead is they simply use an independent trustee, right? If I take somebody like National Advisors Trust Company and say, I'm going to have an independent trustee operate this, they have no skin in the game whatsoever. They're simply going to stand there and follow the law. They're not a beneficiary. They have no conflicts of interest inside of the arrangement. They're simply going to follow the law. Then I can actually make my standard a lot broader than health, education, support, and maintenance. I might just say, as the trustee deems appropriate. And with an independent trustee, I could get away with that as an ascertainable standard. So that also has to do with how people choose sometimes how to set a trustee. And one of the big advantages in my mind of using an independent professional trustee, besides the fact that the trust is going on for multiple generations, you don't have all the succession problems that you do. You know that if Daniel retires as a trust officer, somebody else is going to be replacing him who has that same kind of knowledge, and they're backed up by a whole team of professionals who know what they're doing and are going to make sure that things get done properly. So that's the exception that is created in the code. And there's one other, I'll point out the details of it when we get to it, but it's the power to appoint to a specified class, basically a class that does not include these four things up here. If all I can do is adjust it among a further class, then that is a limited power of appointment as well, since it doesn't meet the definitional test of a general power, self-estate, creditors to the estate. And then there's one other thing that I put on my list, right? We've got 3 general powers. We've got 2 limited powers. And then as, let's call it number 6. And I put it on the right-hand side because it works more like a limited power of appointment in that the right to income does not make you an owner of the underlying property. The right to income does not make you an owner of the underlying property. So whether I say distribute all income on an annual basis or distribute so much of the income as the trustee deems appropriate, whether it's automatic or whether it's discretionary, doesn't matter. Owning the income never makes me the owner of the underlying property. So 1 through 5 are all controlling the principal, right? Let's just call it broadly, the assets themselves. And then number 6 handles just the income that is earned from those assets, right? That's a complicated area in and of itself, but that just separates kind of those two pieces. Are we talking about the income that the assets are earning, or are we talking about dipping into the corpus, into the capital, into the assets themselves for this purpose? Okay, and again, one more thing in a very broad way about these powers is this. When I showed you that chart with the line in between those beneficiaries, the way I've organized this in this chart is simply to say that you could draw the line right here. As long as I stay on the right-hand side of the chart, then I'm creating the safe space, right? The protections that we have for tax protection, asset protection purposes. If the general power appointment is what makes you the owner of the underlying assets, right, that's not going to provide those kinds of protections. And so in most irrevocable trusts outside of marital trusts, you're going to see some combination of the powers that are on the right-hand side. You don't have to use them all, and you can make them broader or more exclusionary if you want to. But as long as you stay on the right-hand side of this chart, that's where you're going to find most irrevocable trusts other than marital trusts. Okay, so that is the upshot and why this is such an important area to understand. Let's take a quick look through each of the different powers so you can kind of see a little bit of the taxation elements of that, and then we'll come back to this summary and kind of add back in and understand where we've been. But I want you to understand all the information that's in the outline. I've packed in quite a bit in there. This is all defined in Code Section 2041 of the Internal Revenue Code. I know you don't care, but I just want you to understand that under Code Section 2041, it's very clearly defined, right? What a power of appointment is where I get all this language from that we're using in here to do that. So it's basically just powers of withdrawal or direction of distribution of the funds that are held in the trust. We talked about the two categories. When you talk about limited, it comes directly out of the code. They use the word limited in there, but they don't say limited power appointment. They just say if it's limited to, and that's where we picked up that word from. The Uniform Act used the term non-general instead of the word limited. But in practice, I find that limited is the most common term that you use. I've heard people say special or other kinds of things. They're just trying to distinguish a limited power from a general power of appointment when they're doing that. But obviously the IRS, from a tax standpoint, is concerned about the broader the power you have, the more likely you are to be treated as the owner of the underlying property. That's basically what they're getting to. In pre-42, powers had to be exercised in order to be taxable. That would be a really old trust at this point, but again, trust can go on for a long, long period of time. So every now and then you'll find some old family trust that's been around, and it doesn't seem to follow the rules that we're talking about in here, and it's simply because the law changes along the way, and so we just try to keep up with it as we're going through. Okay, so general powers. Again, I just quantified out here the 4 things that make it includable in your estate. If you are, make it a general power appointment, is it power to appoint to myself, my estate, my creditors, or the creditors of my estate. And identified there's basically 3 ways to be able to do that. Okay, here's the definition in the code. The term general power appointment means power which is exercisable in favor of the decedent, his estate, his creditors, or the creditors of his estate. So using decedent here because 2041 is the estate section of the code as opposed to the gift section of the code. Same rules would apply, gift or estate side of it, for transfer tax purposes. Okay, but that's where the language comes from. And so here's just a sample lifetime general power of appointment. While a beneficiary is living, the net income and principal, that's what we're concerned with here, right? Remember, income, whether they can get it or not get it, doesn't make them the owner. But the principal of the trust estate shall be distributed as beneficiary may direct the trustee from time to time by writing, signing, and duly acknowledged by the beneficiary. Do they need a reason under that clause? No, they just say, give me money. And you have to say yes. Based on the language of that paragraph, I have no way to turn beneficiary down. Therefore, it's a general power of appointment. And practically speaking, this means that you won't see general powers of appointment in virtually any trust you ever see other than a marital trust. What if I'm married to Ben and Ben is my surviving spouse? People say, well, why did you leave it in trust at all? Why not just leave it outright to my spouse? Well, again, you lose some of the asset protection features that go along with this and some other elections that you sometimes can use in generation skipping, other complicated areas. It's sometimes important that the assets be held in trust instead. I might even be protecting it from a new spouse that person might take on, or from being taken advantage of, and elder abuse, elder financial abuse, those kinds of things. So my spouse is probably the primary person that I would leave if I wanted the equivalent of an outright disposition to my surviving spouse. I would likely use a trust instead and simply give my spouse the ability to take out all the money anytime they want for any reason they want. I've now left it with a professional investment manager as the trustee who can take care of all the assets that are in the trust, but really the surviving spouse has complete control over what's going on. Now, if I give somebody complete control over what's going on, naturally there's going to be no real tax barriers in there. So the holder can withdraw any amount of money during their lifetime. As a result of that, they're treated as the owner of that underlying property for both income and estate tax purposes, right? They're treated as the income tax owner through something we call grantor trust status. A grantor trust is one in which the trust is disregarded for income tax purposes. And the value of the trust is included in the holder's estate as well. So you can see all the tax protections melt away. Honestly, the creditor protections would be melted away. And so as a result of that, lifetime general powers appointment, pretty much only going to see that in a marital deduction trust where the objective of the settlor is essentially to leave the money outright to the surviving spouse. And very, very common in that setting because most people aren't trying to restrict their surviving spouse. But what if I wanted to gear that back just a little bit? Maybe I'd use a testamentary general power of appointment instead. I can still give access through some of the other powers to the principal of the trust, but maybe make it discretionary instead. To obtain the marital deduction, I need to have a general power appointment in there unless I'm using one of the exceptions. So let's just read this language. Upon termination, the trust estate and the remaining shall be distributed as the settlor spouse shall appoint by last will and testament, published and executed after the settlor's death, specifically refers to this power appointment. That's important language in there we'll come back to. In such shares and portions as the settlor's spouse shall declare. So basically it just says my spouse can change the beneficiaries of the trust to whomever they want. If I left this power to my surviving spouse could, if she got remarried, could name the new spouse, right? There's no restrictions in there about who it goes to. So just like having the power to name the beneficiary in a life insurance policy, even life insurance policy that I have at work, which I'm not the owner of, right? The company is the owner of that policy, but I have the power to change the beneficiaries. And as a result of that, that life insurance policy is includable in my estate. I control where that property transfers to, and therefore that's enough to treat me as the owner of that underlying property for tax purposes. So the power to change the beneficiaries, another general power of appointment. Notice this is not restricted to anything. It's over 100% of the assets that are in the trust. Likewise, this lifetime general power appointment doesn't have any restriction as to dollar amount, right, or percentage amount that I have access to. So 100% of the property would be includable in my estate. Same things happens in a testamentary general power, is that it makes it includable in the holder's estate. It doesn't, however, make it income taxable. This power by itself creates no income tax consequence because I don't have access to it under this power during my lifetime. It simply allows me at my death to say where the property is going to go. I just have to say in my will, by the way, exercising the power given to me by my spouse in their trust, and an attorney is going to name that out in very much detail. Basically, you just have to know that I know that I have the power and I'm choosing to exercise the power, right? That's the key thing here in that specific reference element of it. It's a very common thing, for instance, when writing a document. It might be standard language in a document, in a will, for instance, that would be filled out by somebody. Most attorneys have form documents that they start with, and that document might say, I leave all the property that I own at the time of my death, along with anything over which I have a power of appointment. Okay, so you see the sly, I'm trying to grab anything that I could possibly control and decide where it's going to go. But in that standard paragraph, there's no specific reference. It doesn't say, under the power of appointment given to me in this document by this person on this date, in this paragraph, whatever, right? So there's no clear understanding that I know that I have a power. I'm trying to exercise that power. So that's why they put in that specific reference language in the document itself. Okay, so testamentary general power appointment, and this is just an example of how you might have an exercise of a power of appointment. You can see the specific references in here, right? As I'm given this power, pursuant to my exercise in this section of my will, of the power of appointment granted to me in this article of a trust that was given to me by someone along the way, right? So they're just having specific reference being made to what it is they are exercising. And of course, there always has to be some contingent disposition. Where would it go if I didn't exercise the power, right? You always have to have default beneficiaries, these very broad ones in here, but essentially it's going to pass on down to other beneficiaries if that person didn't have the power. Didn't exercise the power. But whether or not I exercise the power, it's still includable in my estate, right? Choosing the default beneficiaries doesn't require me to do anything. So most people, for instance, if it was me and my spouse and we had kids, then I might say I leave all this to in trust for benefit of my spouse, and my spouse can change the beneficiaries if they want to, but otherwise it's going to go equally to our issue per stirpes, right, to our children straight on down our family lines, right? That may still be what my spouse wants, and therefore leaves it alone. Doesn't have to exercise the power. It still goes where my spouse wants, which is equally to our kids. And the last general power of appointment, at least as defined by the code, is the 5x5 power. So the 5x5 power, as I said, is a small version of the lifetime general power of appointment. Okay, it's just a mini-me version of that power. So sample 5x5 power, these are very obvious, obviously, when you see them in a document. So in addition simply means that usually there are multiple powers in the same document, right? We can add these things together, and we have to look at the cumulative whole to understand how much control and how much taxation is driven by the powers. So in addition, during this life of the settler spouse, such spouse shall have the right in any calendar year, so this is an annually recurring power in most cases, including the year of the settler's death, to withdraw an amount from the principal, right? Principal versus income, meaning the assets themselves, of the trust, which is not in excess of the greater of $5,000 or 5% of the market value of the trust at that time. Okay, so we usually lean on the 5%. It's working in the wealth business. We usually have trusts that are worth over $100,000, and the 5% is usually the operable one. One thing I would say to anybody who's a drafting attorney out there is please change this last line, which says of the trust on the last day of the calendar year. Well, the problem is the person comes in May and says, I'd like to exercise my 5x5 power, and I don't know how much money that is. If you just say the last day of the previous calendar year, I would know from the beginning of January exactly how much money that is. I understand that's intended to be generous, I think, because in general, assets rise in value over time, but it makes it a little bit harder to exercise the power. So the difference between drafting and administration, kind of the front of the room and the back of the room, talking to each other and what they're doing. So you can see that now I don't have the right to take out 100% as I did in lifetime general power. Instead, I'm being limited to 5%. Let's just focus on the percentage amount. And so that 5% amount is the amount over which my general power exists. So this is a good example of where the general power isn't necessarily over 100% and therefore only includes the amount over which I have control, in this case 5%. So when we look at the tax consequences of that, only 5% is going to be included in the holder's estate as a result of this power. Again, I might have multiple powers added together. If I had a testamentary general power and a 5x5, which is a lifetime power, I would still have 100% included, but because of the testamentary power, not the 5x5. So it's just an additive, right? You're looking at all the different pieces that are there. It also, for income tax purposes, makes it a 5% grantor trust, just like the lifetime general power appointment made it a grantor trust. This does too, but only to the extent of the power. In some rare cases, you'll see these restricted not to the entire calendar year, but maybe to only 1 month during the calendar year. Again, that closes the window even further, right? Strategic things that people sometimes do to create a strategic advantage. The reason why the 5x5 power was put in there, I believe, was just simply to create the ability to have more flexibility and freedom of distribution without having the whole thing includable in the person's estate. It does create another little wrinkle in the gift tax system, which is if I have the power to take 5% of the money out and I don't, I'm essentially giving it to the other beneficiaries of the trust, right? Not just myself, but the future beneficiaries as well. So they wanted to clarify that as long as it's within that 5x5 limit, then the annual lapse of this power doesn't constitute a taxable gift back to this irrevocable trust. Because I put money into an irrevocable trust, I'm making a gift, right? That's how it got in there in the first place, was a gift or estate transfer that was taking place. And so that's the significance of the numbers 5x5. Congress just had to quantify somehow, how much freedom are we going to give people with this thing and not have some goofy tax consequence on an annual basis as a result of having some de minimis power that we'll put inside of this. So nice that it was quantified in the code. That's why you use or see 5x5 used quite a bit. In some very large trusts, I've actually seen smaller numbers than that. I had a 2x2 power and a 3x3 power in a couple of trusts that I had because, you start talking about 5%. I mean, 5% of $100,000, not a huge amount. 5% of $1 million, now you're $50,000. You start talking about hundreds of millions of dollars in trusts, and that's still control over a huge amount of money. And so it is something for people to look at. Anything 5x5 or less is where you're safe. Then occasionally people just make up powers to do other kinds of things. Nothing to do with creating a 5x5 power. It was just an objective of the grantor. And this was actually to solve another issue in the tax code, which is qualifying for the annual exclusion, right, for gift tax purposes. And so there was a long series of cases that led up to this where estate planners believed something that the IRS said they didn't think worked. And that was that if you have a right to withdraw, if you essentially have a lifetime general power appointment over an amount of money, then that should qualify as what we call a present interest. It's a term used in the code with regard to that property, and therefore qualify for the annual exclusion. So people who are trying to optimize their rights in the code would do that. But some people didn't want to give it outright to the kids, and they want to put it in a trust instead. And so the idea that the legal community came up with in the estate planning area was, why don't we just give them the right to withdraw what you put in that year up to the annual exclusion amount? Seems to me if that's a lifetime general power appointment, essentially, then that should create a present interest. Even if they don't withdraw, they had the right to do so, and therefore we think they're the owner of the underlying property. So starting back in 1968, I think they came up with final rule in 1982. Took a long time to get that stuff through because the IRS really didn't want for that to be the case. But if you think about it logically, for heaven's sakes, yes, they have the right to pull the money out. Let's read the paragraph together. Each of the settlers' children and grandchildren, right, basically all the beneficiaries of the trust at the time, even ones born after the signing of the trust, so the group can grow. That's an irrevocable trust, remember. Shall have a non-cumulative right, while the settlor is living, to annually withdraw upon written request made to the trustee up to the total value of the trust property transferred to the trust by the settlor that year and divided by the number of children in the trust. So if I had 5 kids, for instance, and I put $50,000 into the trust this year, I'm basically saying, let each one of the kids withdraw $10,000. All right, that's how the formula is laying it out. Take this year's contribution, that's a gift, divide it by the number of beneficiaries, and give each one of them the right to withdraw that amount. As long as that amount's under the annual exclusion amount, then you've qualified for the personal interest present interest test for the annual exclusion. And they're usually restricted to a certain period of time, right? 30 days is very typical for that. But clearly, if you just go back to the general power appointment test, this is the power to appoint the money to yourself. I can take my share of that money out. That makes it a lifetime general power of appointment by definition under the code. So again, judge pulled out 2041, went through, read through that stuff, and boom, very clear that a crummy power is simply a lifetime general power appointment, and therefore it seems to meet all the tests of being a present interest for tax purposes. So where do we see these the most? Life insurance trusts, don't we? In fact, they're almost used interchangeably. They're used so widely with irrevocable life insurance trusts, and people refer to as ILETs, irrevocable life insurance trusts, almost always have crummy powers in there, because I might have big premiums on a big policy that's going out to the beneficiaries, but I want to have some control over what happens with the death benefit after the life insurance policy pays off, after I pass away. And so crummy powers are very often used to help multiply the annual exclusion. I don't put it in my normal list of powers of appointment because it came up as a result of case law. It's not written in the law itself, but it gives us a really good example of a very widely used power and applying the law to understanding why it works in the way that it does. Okay, so they're simply a form of general power of appointment. They're just not defined in the code that way, like a 5x5 power, something like that is. Nonetheless, they are there. So in non-general powers, that is to say limited or special or non-general powers, these are the ones that I said have some kind of restriction on them. I'm not trying to get all wonky on you, but I want you to understand where some of these words come from. Sometimes it makes more sense for people. So I've actually got the code on the right side of the page here. 2041 in the definitions, B1 says a general power appointment means a power which is exercisable in favor of the decedent, right, themselves, their estate, their creditors, or the creditors of estate, except that. So this is the exception to the general power appointment rule. And a little smaller, except that a power to consume, invade, or appropriate property for the benefit of the decedent, which is limited, so that's where they got the word limited in limited power, right, which is limited by an ascertainable standard. That's why people refer to it as that. What they just mean is it's a standard. There's some kind of governance vehicle which is ascertainable, which you and I can figure out. Okay, so an ascertainable standard relating to the health, education, support, or maintenance of the decedent shall not be deemed to be a general power of appointment. So this is the one exception drafted into the code very specifically. As long as you can't do any more than basically help somebody to maintain their accustomed manner of living, then we're not going to consider it to be a general power. Right? It's like taking care of your family. If the family has unrestricted rights to use whatever they want to, then that's a general power. But if you can restrict that and say this can only be used for things like health and education and support and maintenance, right? Keeping on with the things that you are already doing in life, or the state of wealth of the individual family, their accustomed manner of living, that is the limited power of appointment. Very, very powerful because it gives the beneficiary access literally to 100% of the money that's in the trust if you want it to. Yet, it does not make it includable in their estate for estate tax purposes. So that's the really key thing with an ascertainable standard. So again, sample language of each of these is put in here. Here you can see I use the classical language with the settler spouse's health, education, maintenance, and support. Right? Trustee shall also distribute to or for benefit of the settler spouse, in this case the spouse is the beneficiary, during life such amounts of the principal. Again, most people don't even notice that distinction until it's pointed out that powers of appointment are powers over principal. Sometimes you'll see principal and income in the same paragraph. It'll say so much or all of the income and or principal as the blah, 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 right, of the trust estate as the trustee in its sole discretion. So here we're exercising discretion subject to the limitations provided in that ascertainable standard. And that's why the words are so important, because it has to meet that description right there. Okay, so very, very important. This is where you get both your level of creditor protection and asset protection inside of that trust is provided here. And this is also the reason why, even though I have access to 100% of the money, I'm not treated as the owner of the money for estate tax purposes. The trustee is the one who has to make that decision. Therefore, I do not control whether I get money from the trust or not. Okay, this is just some of the other language that can be used for the limited power. And then here's the other one that I mentioned that I said I would explain in more detail. The power to appoint to a specified class isn't drafted into the code directly, but the code does define the general power appointment as the power to appoint to myself, my estate, my creditors, the creditors, my estate. So logically, if I had a power to appoint to somebody that didn't include those four categories, then it must not be a general power. Okay, let's make it easier. If a general power is the power to appoint to B, and I only appoint to A, then it's not a general power, right? If by definition, a general power appointment is the power to appoint to B, then appointing to A isn't a general power. So as long as I'm specifying a class of beneficiaries that does not include yourself, your estate, your creditors, the creditors of your estate, which is the definition of general power, then I could have some flexibility on being able to alter the future beneficiaries of the trust and yet not be treated as the owner of the underlying assets. Here's the logic behind this. The settlor, the person who created the trust in the first place, is the one who defined the class. They said, these are sort of the maximum group of beneficiaries that I'm willing to have. I'm going to select among that group that the beneficiaries go here. But if you want to expand to anybody else who's in that group, that's okay. So really, the settlor chose the beneficiaries. You're just adjusting. So instead of the power to change the beneficiaries, I call this the power to adjust the beneficiaries. I'm just playing with the words to try to make it logical to myself. The power to adjust the future beneficiaries within a specified class. And that class can be very broad. My descendants, for instance, could be that class, right? So anybody in my lineal descendant class that would pass on down. That, by the way, also keeps out people like my new spouse or somebody who's not a blood relative of ours. So those kinds of things can be really, really important powers to have in a trust, valuable to be able to maintain the control, but increase the flexibility. Here's why that's so important to a lot of people when they're creating the trust. I will hear from clients all the time, well, I don't want to create a multi-generational trust. I don't even know what my great-grandkids are going to turn out like. I'll hardly know what my grandkids are going to turn out like, for heaven's sakes, right? I see them as children, but I probably won't ever see them as adults, or at least well into their adulthood and maturity. So why would I want to pick the future distributees of this trust without even knowing who they are? So here's where this power comes in so valuable, is it enables each beneficiary level, if I give that power to every beneficiary level, to adjust the beneficiaries generation by generation as you're going down. So that if different things happen in the future and they want to go in a different direction, then you have the power to do that within the defined class by the grantor. That's a really powerful thing. And by the way, if you're a drafting attorney, principal, right? The earnings basically on the underlying assets. And you see this laid out in a couple different ways, discretionary or automatic. In a marital trust, it'll always be automatic because you have to have that for the marital deduction. The entire net income of the trust shall be paid, distributed, delivered over in monthly or more convenient installments, at least annually, to the donor spouse during her lifetime for the rest of that person's life, right? It has to be an income interest for life to qualify for the marital deduction. You could do that for your kids as well if you wanted that to be built in. Most people make trusts outside of their surviving spouse discretionary just because they have more flexibility on what's being done. Why force the income to the beneficiaries if the beneficiaries don't need the income out of the trust, right? It's kind of the idea behind that. From a taxation standpoint, this is also important from an investment management standpoint to know what's happening, because if in fact all income is required to be distributed and the beneficiaries say we don't really need the income, then I could change the investments in such a way that it didn't produce any or as much income coming out. And since the beneficiaries would also be taxed on that income, I could look at the kinds of income that were being earned inside of the trust. This is where investments become a really important tool inside of trusts to be able to control the taxation, but I have to understand powers of appointment to understand how those things work. The bottom one is just a discretionary one, and sole discretion of my trustees to pay any part or all of the income or accumulate any part or all income for their benefit in the trust, and then in some cases to add that back to the principal of the trust. In other words, at the end of the year, usually undistributed income simply becomes principal in that trust, subject to the same discretionary provisions that were there before. But very often income rights are made in a broader way than principal rights are, because again, you're not dipping into the property itself. You're simply using the income that is earned by the underlying property. So just making the technical point that it's not a power appointment technically, but it is a right of distribution. And so I think it belongs in the same list. So that is our little summary of the distribution powers that are out there. I'm going to make a couple other technical points at the end here, but let's just go back through and kind of identify from an income tax standpoint. Again, our income right was down here. If I say all income automatically, that's what we call a simple trust. If I say discretionary income, that's what we call a complex trust. Those are rights to the underlying income. Obviously, if it's a simple trust, all income is going to be taxable to the beneficiaries. If it's a complex trust, generally speaking, income is taxable to beneficiaries only if they receive income from the trust. Either the trust or the estate is the taxpayer. If you want to know more about that, look back at some of our fiduciary income tax primer sessions. In general power appointment, a lifetime general power appointment makes me the owner of all the income. It makes it a grantor trust for income tax purposes, because I have control over all of the principal. Therefore, if I could pull all the principal out, I'd be earning the income on that stuff. And so the IRS says, hey, if you're treated as the owner, we're going to treat the owner for income and estate tax purposes. There's no income tax effect of a testamentary general power appointment, however, because I don't have access to it during my lifetime. It's only the power to appoint at death. And a 5x5 power likewise creates a 5% grantor trust status, where essentially the trust is disregarded for income tax purposes and all the taxation flows to the beneficiary. Here I only have 5% power, so only 5% am I treated as the owner of. Then there's the estate tax side. So lifetime general power appointment makes it includable in my estate. Testamentary general power appointment makes it includable in my estate. And a 5x5 power makes it 5% includable in my estate. Whereas the powers on the right-hand side of the page do not have any estate tax inclusion effects associated with them. So this is where that distinction comes from the three powers on the right side versus the three powers on the left side. Income distribution powers obviously can have income tax consequences. Anytime a distribution is made to a beneficiary, it can carry out income if there's income undistributed in the trust at the time. But having a limited power appointment, say the ascertainable standard in the trust, does not make me income taxable, right? income may follow a distribution, but the power doesn't make it income taxable, whereas the general powers automatically create that level of taxation. So those are the 6 powers that are created essentially in the code, right? Defined out there. It's just the way I quantify it. It just makes it easier for me to be able to understand, to be able to identify them, to be able to communicate them to beneficiaries, and to identify them to settlors. But I can't tell you how valuable that has been over the course of my career, taking a beneficiary who has no idea what's going on in this family trust and doesn't feel like it was explained well to them, and just being able to help them to understand essentially what the trust says. I'm not giving tax or legal advice. I'm just trying to inform and educate somebody as to the basics of how this stuff works. It's confusing. It's all buried in this 30 to 60 page, big, fancy, dancy legal document, and it's confusing to the typical layperson who's looking at that stuff. And if you don't deal with it on a day-to-day basis, it's kind of confusing to us. So hopefully this has helped to clarify a little bit of that area. You'll find all of these concentrated into one tight little area of the document where they, let's say, create a subtrust, and then they'll say, here are the powers that are going to be in that subtrust. And generally, they'll be in different paragraphs as you're going down through it. Okay, so there's our distribution powers through the powers of appointment. This just has to do with a specific reference item that I was making earlier on, where you had to make specific reference. You had to say, I know that I have that power and I'm able to distribute that power. This just is where the codification of that is. The power holder knows of and intends to exercise the power, and the power holder's manner attempted exercise does not impair a material purpose of the donor in imposing that requirement. Okay, so I have to know that I have it and intend to exercise that power. It doesn't require, the legal state of telling you exactly which paragraphs it. If I say I want the money over which I have a power in mom's will to go here, right? That's sufficient. You know that I had that power and I'm intending to exercise that power. Permissible appointment. So unless terms of the instrument creating a power appointment manifest a contrary intent, the power holder of a non-general power may make an appointment in any form, including an appointment in trust in favor of permissible appointee. Just imagine a trust that was going to distribute outright to my 3 children equally, and one of them got into a car accident after the parents passed away and maybe is disabled, and so leaving the money outright to them might simply make it subject to their creditors. You might want a special needs trust instead or something like that. So this kind of power allows you to modify going forward what's happening. If I can distribute to you outright, I can always distribute to you in a lesser form, right? In some kind of controlled arrangement. Very, very important power to be able to have. To create a general power in an appointee, to create a non-general power in any person, to appoint to one or more of the permissible appointees of the original non-general power. So just giving you the permissible forms of appointment inside of those arrangements. And for disclaimer is when you're left money and you say thanks but no thanks, don't want the money that is provided in state law, a power holder may disclaim any or all parts of a power of appointment. I might have, for instance, created a regular marital deduction trust for my spouse. And those are usually extremely generous. I give my spouse the right to take out all income and principal. Right, all income's automatically paid to him, and my wife can take out all the principal of the trust anytime she wants for any reason she wants, and she can change the future beneficiaries of the trust. Right, I load this baby with every power that I can possibly give in there, and maybe for tax planning reasons, we decide that it would be better if it was a Q-tip trust. Well, guess what? My spouse could disclaim some of the powers that are inside of that trust, and we could change a regular trust to a Q-tip trust. Again, this is one of the reasons why using trustees who are professionals and know what they're doing can make a big, big difference in terms of the trust itself. It's running in here. Example. Dan, can you give us an example of the difference between maintenance and support? Is there truly a difference? Well, interesting question. So the tax code says no, there is no difference, that they are synonymous. It says it directly in the regulations that maintenance and support are synonymous. In the third restatement, which is a legal definition, it does give different examples of what would be maintenance versus support. So for all practical purposes, no, there's not a distinction between those two things. Certainly both of those words often get used in the law, and therefore I think the law felt it compelled to come up with 2 different lists of things, which you can find in the third restatement of trusts, which is put out by the American Bar Association. I believe that's the publisher of that. But the the IRS says no, they're synonymous. It says that directly in the regulations, that they're not distinguishable. Very good question. If you've got any other questions, please throw them directly in the chat. I'll stay around afterwards as well to address anything else you got, but happy to take them live as we're going along. Creditor claim. So this is general power not created by a power holder except as otherwise provided. Section B, a point of property subject to a general power of appointment created by a person other than the power holder is subject to the claim of a creditor if the power holder, to the extent of the power holder's property is insufficient, if the power is presently exercisable, and if the power holder's estate, to the extent that the estate is insufficient, subject to the right of a decedent to a direct source from which liabilities are paid. So they're just giving an ordering exercise to try to define exactly where creditors' claims can be taken and where they're not. And subject to 504C, a power appointment created by a person other than the power holder, which is subject to an ascertainable standard relating to the individual's health, education, maintenance, support within the meaning of 26, to give you the exact code section there, is treated for purposes of this article as a non-general power. Again, this is where we get our creditor protection from. So instead of just saying it, I'm just trying to give you some of the legal backups for this stuff all in this outline so that you understand where those pieces are. It's a lot of information, and obviously got a little bit into the law itself because I want you to understand, not just know, but once you understand where these things come from, you'll be able to recognize them in documents and you'll be able to communicate them more effectively to the clients that you serve. So I hope this has been helpful to you. Thank you so much for joining us today. And I will be happy to take questions. So let's hit the chat. There's a question, how is the term happiness used as an ascertainable standard? It's not, other than in one state that I'm aware of. There was an 1800s case, I believe, in Massachusetts, where happiness was created as a standard. The code specifically would say that happiness is not an ascertainable standard because, just imagine as a trustee, somebody comes to you and they say, I want some money from the trust. And you go, well, why do you need it? And they go, it would make me happy. How could you ever say no? So you can understand from the IRS's standpoint, that is not an ascertainable standard, right? It is not something like I have to maintain my standard of living, right? I need to pay my bills. I need to pay my mortgage. I need to keep a roof over my head. I need to pay my electricity. Even country club bills, things like that. It doesn't have to be a luxury. If the family lives that way, that is their accustomed manner of living, that's fine. But happiness is absolutely not an ascertainable standard unless you have some crazy case in your state law that says that it is. If you look at the Internal Revenue Code, it would say that it is not. Even comfort, interestingly enough. I see the word comfort used a lot, but it's usually restricted by another word. It will say support in reasonable comfort. The code specifically says that comfort and welfare are not ascertainable standards. It doesn't use the word happiness, but it would certainly fall under that same jurisdiction. The IRS would consider that to be a non-ascertainable standard, because ascertainable standard means that you can ascertain, you can determine where that line is. Well, heck, everything makes me happy. Money makes me happy. Right? So that's where those kind of things fall apart. Other questions? At this point, if you want to unmute your line, you can also ask it verbally if that's easier than asking it over the chat. Happy to take them either way. And if you need to go. Our hour is up, but I'll stay around to answer any questions to make sure there aren't any hanging questions out there. Let me know if this has been valuable to you, helpful to you in understanding what's there. Do remember, these are recorded, and that recording will be available to you on an ongoing basis, so you can always refer back to it. I know through a lot of information quickly, and if that's new information to you, you can review that information as much as you like. So question is comfort and luxury in a custom standard of living. Generally, I would say the IRS would fight you on that. Again, you can always bring the case. The word comfort was used. The word comfort is in the not the code itself, but in the regulations to the code. It says that comfort is not an ascertainable standard. I would think that luxury would simply be step beyond comfort itself. If it's, again, somehow couched by that support or accustomed manner of living in comfort and luxury, that would be fine because they're defined by that previous statement. So you have to look not just at the words, but the words that surround it to see if there is something else there. People who don't understand this, too, you can understand how people would get into drafting these things and not realize they're crossing a line without meaning to cross a line. So that's very, very important. Now, I'm perfectly willing to stand up for my client, too, and say it's not directly in the code. If you want to bring a case and challenge, then that's absolutely fine. I might want to have language in there if I'm settling that estate because I have to know whether it's includable in the person's estate or not, and that language would I would want to somehow present it to the IRS and make sure that they agree with my assessment. Otherwise, I might be, as a trustee or executor, liable for that as well. So yes, I would agree in general those words would not be ascertainable. And because they're different words, that's, it's important to be able to distinguish those things. We're writing these documents. We're trying to express the intent of our client. So we don't have to use just the generic terms that are given to us in the code, but we do have to meet the spirit of that law in a way that will be there. It's why so many attorneys follow those exact four terms, and there are very broadly accepted, widely used definitions of what those terms mean in the law. So all of that stuff is available to us in various kinds of sources. All right, seeing no other questions, thanks so much for being here. We'll see you again next month. Welcome, everybody. This month's webinar is on portability. So portability is now a permanent part of our estate tax system, permanent until legislators change it. But it doesn't appear that from a bipartisan standpoint, anybody is really interested in changing how portability works and operates. Really, the things they've been talking about is how much would be exempt from estate tax instead. So those numbers will obviously work into this presentation, but we need to keep that in mind because we would expect that those numbers will change at some point in the relative near future unless different legislation is put in place to alter that. So portability is an essential part of the planning process, and it's one of the things that we need to look at on an ongoing basis to ensure whether portability is a better way to go or using the exemption is a better way to go. We say that it's a permanent part of the estate tax rules because it's put in there on a permanent basis. It doesn't mean that legislation can't change it in the future, but nobody's bucking for that to happen. So from a practical standpoint, I would expect that portability will be around for the foreseeable future, and it's something that we can expect to have available to us. Portability in plain English is simply the ability to leave my unused exemption to my surviving spouse when I pass away. The idea of it was to try to make estate planning easier, but in fact it causes some other problems and issues that we need to think about, in particular because we work with the wealth marketplace. And in working with the wealth marketplace, you have more people who are potentially subject to the estate tax. And so we'll take a look at how that affects us. So even though portability has been around for a while now, about 11 years, a lot of people still haven't seen how portability works because you have to have both spouses die before portability really comes into effect, which means you've had to have both spouses die since 2011 to have ever actually experienced portability. So even people working in the business on a regular basis, in many cases, have limited ability to do that. So from a functional standpoint, as we look at this, we're going to look at the rules and regulations. We're going to look at how to use portability, when to use it. We'll look at some of the terminology around it. And as always, ask questions as we go along. We'll be happy to address those issues. The deceased spouse's unused exemption is the technical name of what we call portability. Portability is kind of a slang term for that. We're going to look at predeceased spouses and the effects of remarriage because that can actually have detrimental effects in some cases. And so it's very important to think about that from a practical standpoint. And we'll also look at the strategies to use portability on an optimal basis. How do we make sure that we keep as much flexibility as we can built into the system itself? So since 2011, portability has been in the system, and it allows, again, the first deceased spouse's unused estate tax exclusion. So this is where the initials come from, right? That's just a description of it. but it's called the deceased spouse's unused exclusion. That's where we get that DSU acronym from, and so some people just refer to it as DSU. Again, portability is just an expression that's used in the area. It's not a technical term. So portability is elected by timely filing of the estate tax return for the first spouse to die. Let's just call them S1, right? Spouse 1, and then we'll have surviving spouse or spouse 2. So portability is elected by filing the estate tax return. Why is that the case? Because that is a written recordation of the year in which the person passed away, how much money they had, who it went to, and therefore how much exemption you've used up. Keep in mind, anything going to my spouse or charity does not use up any of my exemption. Anybody and anything else, right? If it's not a marital trust or a charitable trust, any other trust or any other person other than my U.S. citizen spouse or a charity would use up part of my exemption. And so by filing the estate tax return, you've got a recordation of who's receiving the assets, how much the assets were worth, and therefore how much of your exemption was used up at the time. There it is in writing on an official government document. They don't want you to go back when the spouse dies 10 years later and try to look back and see what happened back then. All the appraisals and everything else are going to be problematic at that point. And so simply by filing the estate tax return at the time of death, they can see that. They can also see when the person died. As I said, it's only been around since 2011. So I might think, in fact, there's a lot of people that I come through classes with me who've only been in the business during the era of portability. So it's the only law that they've ever known associated with this. But if the first spouse died, let's say in 2009, and the surviving spouse is dying today, if you live in the era of portability, you're thinking, we must get portability from that first spouse, right? Look at their estate tax return. The IRS will pick up that right away and realize they died in 2009. That's before portability came into effect. And so even though portability is in the law now, it wasn't the law at the time the person passed away. And that's really, really incredible, important. Yes, the slides will absolutely be shared with you at the end of the class, I think is when they put them up. DSU is the unused portion of the basic exclusion amount. So I don't mean to get so technical on terminology, but it's important to keep them separated. What is the basic exclusion amount and what is the DSU? Because of course, if I'm the surviving spouse, my basic exclusion amount continues to be indexed. It continues to change over time. But the DSU that I got from my spouse who passed away is, of course, frozen at that number, at the time that they passed away and the amount of exemption that they used at the time. So we have to keep track of those two things. They also get used in a particular order, a very generous order, I will say. So if I give stuff away, I'm going to use DSU before I'm going to dip into my basic exclusion amount. And that's an attractive thing from a tax planning standpoint. So very, very important to do. But the key question becomes this. Is it better to pass the exclusion to my spouse, that is to say, to use portability, right? To pass the exclusion to my spouse, to use later on to qualify everything for the marital deduction, right? Very simple way to plan things. I simply leave everything to my spouse. There's no taxes because of the unlimited marital deduction, and my unused exemption then passes over to my surviving spouse. So that's passing the exclusion, right? Utilization of portability. Or is it better to go ahead and use the exclusion, meaning more like the old style A-B kind of arrangement, where I go ahead and subject what I have to tax up to my applicable exclusion amount, because that's the amount that I can pass estate tax-free. I've now used my exclusion rather than passing my exclusion to the surviving spouse. And the surviving spouse would then have their basic exclusion amount. We used to have to do that because we didn't have portability, and so that was standard operating procedure. And when portability came along, a lot of people thought, well, portability is a lot easier. I can just pass everything to the surviving spouse. They'll get twice the exemption, and we're good to go. And for some people, that absolutely works. But there's also times where I would put some caution into that area. Okay, either way, we don't pay any estate tax when the first spouse dies. Either technique that we use, we are eliminating the estate tax at the first spouse's death. In portability, you're qualifying for the marital deduction. If you're not using portability and you're trying to use the exemption, we're going to use the exemption only up to the applicable exclusion amount, the amount that I can leave estate tax free. right? Anything else will qualify for the marital deduction. And so that's where we get our A and B trust from through that process. So portability is basically passing the exclusion amount to the surviving spouse, right? Spouse one passes away. Let's say they've got a revocable living trust or a will, doesn't matter. And they're just going to leave everything basically to the surviving spouse outright. Anything I leave to the surviving spouse outright, using a will, using a trust, using joint tenancy, using a beneficiary designation, however it is you get them there, that is going to qualify for the unlimited marital deduction and therefore not use up any of my exemption. So my exemption, currently $12,060,000, is going to pass over to the surviving spouse. So my surviving spouse, let's just round it off at 12 if we can do that simplicity for class here. My surviving spouse has a basic exclusion amount of $12 million. I have a basic exclusion amount of $12 million, and my unused exclusion then, I'll change the color, is going to move over to the surviving spouse's side of the balance sheet and become DSU. And so now basically my spouse has two exemptions worth that they can pass without any estate tax being paid. Okay, that's the basic idea here. Now, you can do that not just outright, but you could also do it in a marital deduction trust. So let's say that some control is desired in an arrangement, right? Q-tip trust or a typical vehicle that might be used for something like that. Still qualifies for the marital deduction, but for instance gives S1 the ability to determine who the ultimate beneficiaries are. Maybe S1's got round kids from an earlier marriage and S2's got square kids from an earlier marriage. And so I might have a concern about making sure that my spouse is taken care of, certainly, but being able to direct where those assets eventually go. So there's reasons why people would use trust to do this rather than outright disposition to do that. Absolutely fine. Either way works perfectly well. Okay, so surviving spouse now has all the exclusions on their side and can pass things down. Again, when you have different beneficiaries down here, you might be a little bit concerned about how that's going to be allocated. That's where the control aspect come in. Anytime you're dealing with control, you're dealing with need or potential need for a trust. Okay, so that is kind of straight out portability in a nutshell. Portability is quite simple. And that's one of the advantages of portability as a planning technique. And honestly, one of the reasons why I think Congress put this in the first place, whoever drew up those rules for Congress. Keep in mind the UK's had some similar arrangement for a long time in their law, and the US and UK law tend to be very similar in terms of their overall construction for estate planning. I think that the policy people behind the scenes learn from each other and some of the things that they do. And so my expectation is we probably picked up that idea from their system. It's a simple type of arrangement because it gets around having to do the AB trust arrangement, which was the traditional way we did things. We'll go back into that if you're not familiar with that in a second, because that's the use the exclusion methodology. One of the big advantages that people stressed about portability is that the assets get a second step up in basis. That is to say, when the assets are includable in my estate, of course, you get a step up in basis to the fair market value at the time of my date of death. So you get a step up on the transfer here. That's step up number one, because they're includable in my estate. Doesn't matter that there's no estate tax on it. You still get a step up in basis anytime the assets are includable in your estate for estate tax purposes. When the surviving spouse dies now with those same assets, maybe they've continued to appreciate in value, and you get a second step up in basis when the surviving spouse dies. So pretty sweet deal, no estate tax and two step up in basis. These days, especially with the exemption so high, many people don't have estate tax anyway, right? The vast majority of Americans, about 1/1000% of Americans are paying estate tax these days. It's a tiny, tiny fraction of the overall people. But that exemption, remember, is expected to go back down. The law automatically in 2026, just a couple of years hence, about 3 years, we've got to be able to run with this $12 million exemption amount. That's one of the reasons why a lot of people have been giving away $12 million if they can afford to do so. Again, tiny, tiny fraction of the world that can afford to do that. Most of us look at 12 million and go, I'm never even getting there, much less 24 million. But the exemption is going to go down to approximately half that, so it would be $6 million, right? It's $5 million indexed for inflation. That's what we're going back to automatically if Congress doesn't draft a new law changing the estate tax. The Biden administration has tried to make that happen sooner, but they haven't been able to get those bills through. So We'll see where that goes. That's still pending out there. We can only operate under what we know is the law. Now, here's the potential problem with this little exchange. The Biden administration's number one tax priority, as I've heard Joe Biden himself talk about, it's one of the things that he ran on, is that he thinks the step up in basis at death is the biggest loophole in the code. Again, I'm quoting him, I'm not attaching messages to him or just Democratic platform stuff. He said this directly. So this is, without a doubt, one of the areas that they want to target. That's one of the things that gives me pause in trusting that portability not only is going to create a zero estate tax, that's where most people are anyway, but that I'm going to get that second step up in basis when the surviving spouse dies. And so I want to look at the advantages and disadvantages on both sides of the equation. But as the law plays it out right now, absolutely, that is the way that it works, and that's very, very effective, since for most people who don't have an estate tax anyway, it's really become an income tax game, right? How do you get the best step up in basis for income tax purposes instead? There's certainly certain assets like retirement plans with the new proposed regulations under the Secure Act. We'll talk about that in one of the upcoming programs. Even some people don't like to have their residences held in trust. You certainly can hold a residence in trust. It's not a problem. But some people just like that idea that they own that thing outright. And certainly the retirement rules when you're dealing with trust get a little bit more complicated than just leaving things directly to somebody. And retirement plans, frankly, make up a substantial amount of the estate of the average American. It's the single largest assets for most people. Oftentimes their residence is their first or second largest asset as well. So between those two, you're talking about a substantial amount of the net worth that the individual tends to have. It does put absolute control on the surviving spouse. I've had lots of clients who really like that feature. They just don't want to have any kind of restrictions or barriers between their spouse and the money. So I say when desired, because sometimes the surviving spouse doesn't have the interest, the willingness, much less the ability in some cases to manage that money. They just might be skilled in that area or desirous of learning how to do that. You also may pay less income tax, because when you're dealing with trusts, as we know, trusts tend to pay tax on accumulated income at a higher rate than individuals do, right? They just have compressed tax brackets, so they get to the top tax brackets faster. That money in the hands of an individual gets taxed to the individual. Now, if a trust passes the money out, the income out to the individual, it'll still get taxed at the individual rate. So those are things that we can manage, and we can also play around with from an investment standpoint, right? We certainly know if the trust is going to be the taxpayer and they're at a higher tax rate, we're going to invest in different stuff, maybe tax-free bonds or qualified dividends or things that don't get taxed at the maximum tax rates. So certainly portability makes a lot of sense for smaller, especially non-taxable estates. And when I say non-taxable, again, I'm keeping my eye on the future. Unless your client is terminally ill, the chances are that they're going to live to the point where, according to current law, the exemption is not going to be 12 million indexed, really 10 million indexed. It's now 12,060,000. It's going to be 5 million indexed, right? Currently about $6 million that would pass estate tax free. So to me, that's the threshold for net worth, right? All in, all of the client's assets, every single thing that they own, if they are at or above 6 million or likely to be by that time, this is where the estate planning comes in. So typical Americans got, let's say, 1 million or 2 million or $3 million, and really based on the way that they invest and the way that they're using their money are not likely to grow to anything more substantial. Portability is a very simple way to go. But when you start looking at that potential taxable estate above $6 million, right, for one person, being able to utilize the exemption may be a valuable consideration. I would suggest I lean in this direction, and I'm going to show you an even better way to be able to take advantage of it. But this is the old AB trust, right? We call this the AB trust. Typically, the marital trust is called the A trust, and the B trust is the bypass trust. It doesn't really make any sense the way I have the arrows drawn, but the formulas that attorneys use very often say, when I die, leave everything in trust for my surviving spouse, A trust, except the amount that I can leave estate tax-free. So the arrows would look like that instead, right? That's where we got the traditional AB before there was an unlimited marital deduction. That was a very typical way that the formulas would be written, and some people still write the formulas that way. So that's where the pieces come from. Easier for most people to understand if I just say, when I die, leave the amount that I can pass estate tax-free. So currently that's about $12 million into a non-marital trust, right? We'll call it the bypass trust here, credit shelter trust, exemption equivalent trust, family trust, whatever the attorney chooses to call it. Doesn't matter. You can call it the Mickey Mouse Trust. Only matters what powers are in that trust, okay? So this is the amount that I'm actually subjecting to tax. I'm going to subject this to tax, and of course, I'm going to use my tax credit to eliminate the taxes. If I put $12 million in there and I've got my credit up to $12 million, then my taxes end up being zero. That's the concept of the bypass trust. So I'm using the exemption amount. I'm actually using up that rather than passing unused exemption to my spouse. Now, if I only had $6 million and I've got a $12 million credit, I could still leave $6 million into the bypass, and the other $6 would pass to the surviving spouse. So portability still exists above whatever my net worth happens to be at the time of death. If my net worth is over the exemption amount, then we simply have this little relief valve. Anything over the credit that's available at the time of death will pass over into a second trust, the marital trust. And that marital trust will qualify for the marital election, and you'll notice that it's on the surviving spouse's side of the balance sheet. So let me just enhance this line right here, right? That's the dividing line between the S1's stuff, right? When they pass away, the stuff that's treated as passing not to the spouse, and everything on the right-hand side of that line belongs to the surviving spouse. The surviving spouse's own assets, of course, we don't know who's going to pass away first, so generally speaking, we would say they would hold those assets half-half. That's why I've got the half up here, right? And the surviving spouse's plan would say exactly the same thing. We just don't know who's going to pass away first. So now I've got the bypass trust and I've got the marital trust holding the excess. The marital trust then becomes includable in the surviving spouse's estate when they die. So in this example, let's assume that we've maxed out the exemption amount. Now we'll use today's numbers. I'll just round off the $60,000 just for simplicity's sake. When I pass away, let's say that I'm worth, just make it a taxable estate for our purposes here. Let's say I'm worth $20 million. That means 12 could go into the bypass and my other 8 would go into the marital trust. My surviving spouse, again, I don't know who's going to pass away first, has the other 20. So when my surviving spouse dies, 28 would be includable in surviving spouse's estate and subject to the rules at the time my surviving spouse dies. Okay, so they would have let's put the credits in. I would have a $12 million credit, and that credit would be used against this trust, giving me a zero tax. And when my surviving spouse dies, they would have their own $12 million or whatever to index to at the time, and it could go down because in a few years that number will be lower according to current law. And so that $12 million could be used against the estate tax at the time the surviving spouse dies. What these plans do is it makes 100% of the money available to the surviving spouse while not paying any estate taxes at the first death. So we're delaying estate tax until the surviving spouse passes away. And what this one does differently than the first plan, where we just left things outright to the spouse or just used a marital deduction trust, is we're using up the exemption, at least a portion of the exemption that we can of the first spouse. So let's look at some of the pros and cons of that instead. Kind of the big four that I look at, not necessarily all going to be pertain to the particular client that you're dealing with. But one of those is to lock in the exemption, protecting against negative future changes in the law. I don't know what will happen in the future. I do know if I use the exemption now that I have the exemption that's available at the time of my death. The DSU, frankly, and I'm just going to make a statement, I'm not trying to scare you or indicate that anybody is even proposing this. I have not seen this proposed by anyone. But simply looking at the law and having been in it for a long time now, the DSU is a tax credit. It only applies to very wealthy people. Right? From a practical standpoint, you don't pay any estate tax unless you're worth over $12 million per person. 24 for a couple. So a unused tax credit for very wealthy people. If Congress wanted to raise more taxes, do you think that would be an easy thing to go after? Notice that it's not grandfathered. Now, again, it's a permanent part of the law as written, so they'd have to legislate that change in the law. But there's no doubt in my mind that it would be easier for Congress to say, hey, there was that rich people's tax credit a few years ago. We're just going to remove that now because we think that's unfair. As opposed to this situation where I have actually used the exemption, and therefore I have an ex post facto transaction. I am grandfathered because I've already irrevocably transferred the money and utilized the law that was in place at the time. Whereas in portability, what I'm doing is I'm transferring over to my spouse and assuming that in the future that tax credit will still be available to the surviving spouse. So understand that there's really only one way for it to go, and that's against me. If they raise it, make it more generous, beautiful. We have even more available to us. That's a better thing. But that's one of the concerns that some people have, is that there's a reason why there's that expression, a bird in the hand is worth two in the bush, right? I've already used up that exemption. I know exactly what I've got. I know exactly how that worked under the law. And that may be better for me in the future. There's also future things that could happen that would have negative effects. We'll talk about those in a little bit. Second thing is to allow the bypass portion to grow beyond the estate tax-free amount, right? Many of us, most of us probably on this call, are in the investment management business or something closely related to the investment management business. When you're professional on that side, your tendency is to look at this diagram and go, okay, so the surviving spouse has $20 million over here. Let's call that account number one. We've got a marital trust with $8 million over here. Let's call that account number two. And then we've got $12 million in this bypass trust. Let's call that account number three. Well, if the spouse doesn't have a $40 million lifestyle and they're drawing against all those assets, obviously I'm going to draw on account number three last. It's the most tax protected money that is there. If the surviving spouse can live off of the money in their own pocket and in the marital trust combined, then that will allow us to hold these assets and invest them for growth. If that 12 million grew to 20 million, and I know that seems like a big leap, but it's really not. The average surviving spouse lives about 8 years after the first spouse. That's just the statistical average. Using the rule of 72, money doubles every 10 years at a 7% rate of return. So if I get a 70% rate of return, 8 years later, I'm not going to quite have doubled, but something close to that. And so, again, not an exaggeration by any means. If that 12 million grew to 20 million, by the time the surviving spouse dies, that money would pass down to the beneficiaries completely estate tax-free. Whereas, if that money tracks over to the surviving spouse at 12 million and grows in value, again, the use by the surviving spouse doesn't change, grows in value from 12 to 20 million, everything over 12 million would be taxed, right? The DSU's frozen at 12. So in our business, that's one of the big ones that we look at. Obviously, it's very germane to the nature of the client, how much money they have, what they're likely to have by the time they pass away based on their spending habits, etc. But that's a huge one for a lot of people to think about, because it freezes that value. Again, we're talking about people with taxable estates or potentially taxable estates in this arrangement. You can also protect against the dramatic rise of even modest estate, right? I'm not setting my estate plan based on winning the lottery or something like that. But if people are invested in equities, and especially growth types of equities, or if they have their own business, if they own land, right? There's certainly a lot of people in the countryside of Pennsylvania who had a couple acres, never thought they were going to be worth anything, and suddenly some guy comes knocking on the door and asks if they can frack in their backyard. And they say, excuse me. But, suddenly they're millionaires instead. I'm not worried about the person who's invested in time certificates down at the bank, but anybody who's invested actively in the marketplace or has assets that could rise in value, that is something to keep in mind. And it's also easier. You can do it either way. You need to use a trust to do it in the portability way. But it's easier to lock in the generation skipping transfer tax exemption. GST exemption is not portable. GST exemption is not portable. So since portability is just an estate tax issue, a lot of people only talk about the estate tax side of that, and sometimes it kind of gets missed that GST exemption needs to be used along there somewhere as well. GST exemption makes the overall estate experience multi-generational much cheaper. And so from a practical standpoint, it's nice to be able to have that option available to you. So those are some of the big reasons that are pro-bypass trust. There's certainly other advantages that come out of using the exemption rather than relying on portability. One of those is to lock in the credit in case of future marriage. So just imagine this. Let's take the same example we just had. I pass away. My basic exclusion amount for S1 passes over to the surviving spouse. They have their 12 million basic exclusion amount. And from me, I'll just color code this differently, my 12 million of DSU gets added to the spouse's balance sheet here. So now we've got a surviving spouse basically with 24 million in applicable exclusion amount, the amount that surviving spouse could leave completely estate tax free. Okay, that's very surface level, what we all know of the workings of the portability. So now spouse one is out of the way, and surviving spouse gets remarried. Call them trophy spouse. Okay, so she's looking around, she's got some big bucks, and suddenly she can afford somebody. First one's for love, second one's for money sometimes. If the first one didn't have that, and the third one's for other characteristics. So her trophy spouse now comes into the picture, and let's say the trophy spouse, when that person passes away, has an estate plan that leaves some assets to their kids, right? They're grown adults after all. Kids are empty nesters, and so the kids are out of the house, and they don't have really a relationship to them, and so maybe when the second spouse passes away, they leave some money to their kids. Let's just say $4 million I leave to my kids. And by the time we pass away, by the way, let's say we go down to the $6 million exempt amount. 5 million index for inflation is where the law is going. Out of that 4, by the time that person passes away, there's only 2 of unused exemption. Well, guess what? That doesn't get added to the spouse's 24. This person is now the most recently predeceased spouse. And this number gets eliminated. I'll draw through it first, which means this number is going to go down. So now I'm going to erase that number and replace it with the DSU of the new spouse. And so notice that that spouse has just gone from 24 million exempt to 14 million exempt. And in fact, if the exemption had gone down to 6, her basic exclusion likewise would have gone down. And so maybe I'm at $8 million instead. So it's all facts and circumstances of what the law looks like at the time people pass away. But what you see is that there's a notable reduction in the exemption of the surviving spouse. So future marriages can affect to the negative how the DSU works for the first spouse, right? You only get the DSU of your most recently predeceased spouse. There's ways to work around that, but it requires having a huge amount of money because you'd have to be able to give things away. If you give away the DSU of the first spouse, you can lock it in, even as the surviving spouse. Very, very important that if the person's going to get married again, that we take a look at what the effects are on how the estate tax exemption works. And I think most people probably figure that they wouldn't get remarried again, but it's a very common thing to happen. So very, very important to understand if somebody is looking at remarriage to do some prenuptial planning. A lot of people don't do tax planning before their marriage, and so maybe do some postnuptial planning. Notice that it wasn't the remarriage that changed the applicable exclusion amount for the surviving spouse. It was the death of the second spouse. So yes, you can do after death planning. After death planning would also be able to address this. It's just a little known area that a lot of people don't pay attention to, and it's very, very important to address. So again, by using the exemption trust, what would you have done? $12 million would be in there for the surviving spouse for the rest of their life to support them. And that money would already be locked in as far as the exemption goes. And have this issue of a reducing exemption probability amount. I'm hearing somebody with some noise out there. If you just check to make sure that you're muted, that would be appreciated. So if you have spouses that aren't necessarily from this country or family overseas, the spouse expatriates, that money's not theirs for the exit tax. You might have a state level estate tax. I don't know of any state taxes that have portability. Not saying they don't. I'm not familiar with any that have portability in their state tax laws. And the state estate tax number, the exemptum number, tends to be quite a bit lower than the federal number is, somewhere around $1 million, $2 million, $5 million for the most generous ones. So from a practical standpoint, a big gap between those two numbers currently. Also, it can enable the changing of situs for state income tax purposes. If I hold the money in an irrevocable trust, like a bypass trust, that trust can be sitused anywhere. And so by situsing that trust in a state like, say, South Dakota, very popular destination for those kinds of things, right? There's about a dozen states that vie for that kind of business. They don't have a state income tax. Can't get around the federal tax, but I can get around the state tax by simply placing the situs of that trust in a state where there is no state income tax. If the income is retained by the trust, it would pay federal tax, but not state tax. It can also, for a litigation attorney, pointed this out to me, that it lowers the audit risk for hard-to-value assets. In other words, what this person said was they do a lot of litigation in the area. They use a lot of family and partnerships and the like to reduce the value of the assets that the individual has. And basically what this person said was, when the first person passes away, if I just leave everything surviving spouse, there's really no reason for us to have the discounting techniques in place. It doesn't help anything. Everything is based on what happens at the surviving spouse's death, and you fight that valuation case and you either win it or lose it. But he said, if I use a bypass trust, and when the first spouse passes away, I'll put some of those shares into the bypass trust using the discounting techniques that we put in place. That should reduce our overall valuation and sets up a situation where the IRS needs to fight it now, right? It's basically a 3-year statute of limitations with respect to that money. His contention is that it's basically a no-win game for the IRS. Fighting the valuation case, even if they think the numbers are wrong, can take a long time, can be expensive because they have to get their experts, and you have to go to court, and you have to do all the things that are necessary to do it, and they'll get a 0 result even if they win, because remember, the bypass trust only holds the amount that would pass estate tax-free. It would just change the amount that was funded into the trust according to the formula that's being used. So pretty sly. Says basically it reduces dramatically their interest in attacking that because they have a zero-sum game from attacking it. And when the surviving spouse then passes away, if they attack the valuation then, they'll just say, well, that's the same valuation method we used on the first death, fully disclosed on our estate tax return, and you were happy with it then. Why is it different now? So there are different ways to be able to approach this. If you've got other advantages that you see in using either bypass trust or portability, please share them. You can share them in the chat or just email me afterwards. It's always interesting to see how people are using this stuff in real life. Well, I've had a lot of time to think about how these aspects of it work. I've seen very few situations where both spouses have died in the last 11 years, and you've actually had an impact of that. So looking at all of the possible permutations that go along with it, very, very important. So you can also use a standard bypass trust, and you can use a Q-tip trust as the form of marital deduction trust. As we said, if you have control issues in the family, let's say I've got round kids from a previous marriage, my spouse has square kids from a previous marriage, and I want to be able to control where those assets eventually go, Q-tip trust can be used to do that. So it fits into our perfect marital pattern just as with everything else. There's another way that we can utilize that Q-tip trust, and that is to make a thing commonly called the reverse Q-tip election. And this was the way that I talked about being able to utilize the generation skipping transfer tax exemption against a marital deduction trust. So whether there's a bypass trust used or not, if I did the full portability and left things simply outright into a Q-tip trust, I can still do what's called a reverse Q-tip election. I can treat the spouse one as the transferor of the Q-tip trust for generation skipping transfer tax purposes, even though I'm treating it as the spouse's money for estate tax purposes. I'm treating it as surviving spouse's money for estate tax purposes. I'm treating it as this deceased spouse's money for generation skipping transfer tax purposes. That sounds silly. If you don't know a lot about them, don't worry about the details of that now. Just trust me. But because estate tax and generation skipping transfer tax are not unified, we can make two different elections. We can make one election that says, for estate tax purposes, that belongs to the surviving spouse, and for generation skipping, that belongs to the first spouse to die. That's built right into the code. It's not a loophole or some fancy thing that we're doing. Congress recognizes where there are gaps and differences between the two and has always allowed that. In fact, it goes back to the very beginning of generation skipping back in 1986. The estate tax exemption was $600,000. And the generation skipping transfer tax exemption was $1 million. So there was a gap from the very beginning between those two. The numbers have synced up now and been the same since about 2004. But for a long time, there were two different numbers. And so naturally, in the law, they built in a way to be able to utilize that extra GST exemption that wasn't available under the estate tax side. So Q-tip trusts are a very common trust to see used in this type of planning. There's also an alternative way to do this, which is leaving the money outright to the spouse and using a disclaimer. So a disclaimer would basically say, let me just draw it here. Let's say I create my estate plan to leave everything outright to the spouse. I draw the whole AB trust that we have below down here. I design all of that stuff in, but I essentially misfund it. And I just pass everything to the surviving spouse. If I put everything joined with rights of survivorship, it's going to pass right out to the surviving spouse. And then the surviving spouse is in a position where they could disclaim some of the money, right? This is what the disclaimer method is doing, is that you would sit down with your attorney, and your attorney would say, well, it might be better to go ahead and use some of the exemption. Why don't we go ahead and disclaim some of those funds? They would fall back into the estate of the individual and say, where do they go next? And they could fund a bypass trust and or marital trust. And uniquely, a surviving spouse is the only person who can disclaim money and still be a beneficiary of the resulting disposition. That's a really cool little benefit that you'd have. Anybody else, if they disclaimed the money, wouldn't be able to continue to be a beneficiary of the trust that it then fell into. But a surviving spouse can. So that gives us a little bit more flexibility in there. There's no doubt that that technique legally works. Here's where my concern is, just from a human standpoint, and having been in the professional side of the trustee business for a long time. The surviving spouse is the one who must execute the qualified disclaimer. And there's certain rules to that, certainly. It has to be in writing, it has to be done within 9 months of the creation of the property interest. They can't have received any interest or benefits. They can't have any retained powers associated with it. It will pass without direction by disclaimant. That's why you need the base estate plan in place. And the disclaimant is treated as having predeceased the transfer, and so the money simply falls down into that next trust and goes from there. Here's the problem. The surviving spouse is the one who has to sign that disclaimer letter within 9 months. And I think you and I have both worked with enough surviving spouses that you realize this is one of the most difficult times of their life. Actually, the life expectancy is the shortest for the 6 months after my life partner passes away. That's the highest risk time in my life for a surviving spouse. It just crushes a lot of people. Emotionally, certainly, you can understand the impact that has. You can see people mentally or physically decline sometimes during that period of time. It's a very, very difficult time for someone. And when people are getting advice, I think you and I both have heard the advice many times where they say, don't make any big decisions for a year, right? Basically, while you're in that mental state. Well, guess what? This is a big decision. You're irrevocably turning down the money that was given to you in its current form, and you have to do that within 9 months of date of death. So while legally I totally understand that that plan does work, it really takes, in my opinion, having fire drilled that a number of times with my professional team beforehand. You don't want the first time somebody's hearing and trying to understand how that plan really works to be after their spouse passes away. So that has become a very common form of planning. I'm not a big fan of it just because of the human side, not saying legally that it can't work. When you're using a Q-tip trust, which is my preferred method for that, you can look at some of the powers that are in that Q-tip trust and say, is this something that's going to work given the situation that I'm trying to do this in? So let's just review the powers for a Q-tip trust. If I'm using a Q-tip as the form of marital deduction trust, either in an outright portability disposition or in an AB type of setup, a Q-tip trust at the minimum has to have all income for the surviving spouse for life, right? You can't cut it off if they get remarried, and it's all income automatically, right? It's a simple trust for income tax purposes. It will all pay out to the surviving spouse. Now, you can add on some very generous features in addition to that. I could give you access to 100% of the principal by putting in the ascertainable standard. Some people know as the HEMS standard, health, education, maintenance, support, right? Something basically says you can have as much of the money as you need to maintain your standard of living. There has to be a reason why that money is coming out, but that can give you access to 100% of the principal. I can be even more generous with a portion of
This Creditors in Commerce classroom session, hereinafter session, is the private exchange of ideas and concepts between the providers and the recipients. The content is not meant as legal advice. The use or attempted use of any idea or procedure discussed in this session as applied to the recipient's own personal transactions, cases, or controversy, or applied to other cases, may or may not result in a favorable outcome or the same outcome as discussed in this session. Each transition or transaction, case, or controversy may be different as a result of unique actions or unique statements made by the parties therein, and each different act or statement in any transaction affects or may affect whether any procedure or idea discussed in this session is relevant to your transaction or that the outcome thereof will be depicted as in this session. The discussion of ideas or procedures in this session is not exhaustive of the subject being discussed. Many ideas and concepts that can affect the outcome of any legal or commercial procedure are not discussed in this session, and the fact that you may not be aware of these issues may have an adverse effect on the outcome of your procedure. It is the responsibility of each party to understand his own transactions and to apply the appropriate and complete concepts necessary for a procedural and substantive remedy thereto. This session may be redistributed privately by any recipient to another recipient requesting them, conditioned upon the fact that this notice is provided therewith. If you have any questions, you may contact Brandon by email at harmony@creditorsincommerce.com or by telephone at 702-866-9077.
Yeah, oh yeah. Well, we're gonna distribute them anyways. Alrighty, welcome. I'll just hold these on for right now. Okay, for those of you who have done the classes in the past, you know a lot of times I don't prepare, and I didn't prepare anything for tonight. I figured what we would do tonight is a recap, kind of catch everybody up with what we've done and where we've been, what we've learned up until now, talk a little bit about what is, okay? I'd like to start off. The purpose of these classes is to not only give you a little bit of knowledge that you can, well, is this better? All right, I'll try to speak up so you guys can hear me. Can everybody hear me? I speak like this? Okay. All right, the purpose of these classes, the reason why I'm doing these, why we put these together, is to get a little bit of knowledge out there so that you guys can not only get yourselves out of any predicaments or situations you may have, but so that you may also start to focus out on the community and give back and create something better. Something that we talk about a lot in these classes is responsibility, and how this knowledge comes with a high level of responsibility. Okay? There is no, you don't want to use this knowledge for selfish reasons. Okay? As you'll see, and as we demonstrate, and a lot of what we have learned is that everything's universal law. Well, that's the word I like to put on it. But no matter what your religious or spiritual belief system is, every single one of them talks about the energy that you put back is what, the energy that you put out is what comes back. Okay, is there anybody in here that would disagree with that concept? No? Okay. So, when you are putting out or giving away with the expectation or the condition of getting something in return, that's selfish reasons. And you'll start to see things blow up in your face when you start to give that way. Okay? I know a lot of you may be new to some of these concepts. Some of you have already gotten returns and things like that based on some of the technologies we've discussed. Okay? But it's what you do with that once you've gotten it that's going to really put you into harmony or balance with the world. Okay? Sharing this information is good, provided that when you share it, you also give it in such a way that you convey the message that this is something that requires responsibility. Okay? Being responsible is the most important thing when using these concepts and these processes and procedures that we discuss. Now, being responsible is also covers the way that you act with people, the way that what your intention is when you speak to people, when you act with people, when you interact with people. Okay? When you may, some of you, and I've gone through this personally, you may be confronted and challenged on your position by agents of the government, the Treasury Department, IRS, CID. Anyone not know who CID is? Okay, that's the Criminal Investigation Division of IRS. Accountants with guns. Okay? So keep that in mind, because your intention in dealing with them is what's going to determine what comes of that situation. If your intention is to obstruct, delay, avoid responsibility when dealing with these people, then the hammer will come slamming down on you. If your intention is to assist, to bring a solution, if your intention is love, I know this is a hard concept to get, especially in dealing with the IRS, but if your intention is love, truly unconditional love, that, hey, these are human beings, just like you. There is no us and them, okay? There is just us. Okay? When you start to create a divide, a separation, you start to judge based on their job, based on their words, based on anything that you make judgments about. You can make judgments about their clothes.
What the law says.
I
could have a document that literally makes no reference to the fact that you can make all these different elections out there. After all, it's not a paint-by-numbers document. There's a lot of attorneys who have concerns about that because a lot of times they'll use individuals who are not experts in the area, and so they want a document that says step by step by step, here's what I want you to do at each step along the way. So that flexibility simply exists in the law. So I have to have a trustee who has knowledge of the law so that they can appropriately make the choices that would be best for that client. That's a very, very powerful position to be in. And so for that reason, for the right couple, I think the single Q-tip trust is a tremendous way to go. It gives us all of the best options available on both sides and the maximum amount of flexibility, right? We can have full marital for portability purposes. We can have full bypass for use of the exemption. We can have any combination of them. We can further split within that plan for the state estate tax when that's appropriate. We can deal with generation skipping and do splitting if we need to for that portion as well. This is right in the Internal Revenue Code. There's no questions about how it works. We know exactly how this works. It's just choices that we make and elections that we have to make on the estate tax return when first filed. So if you put that decision into the hands of professionals as opposed to a grieving layperson, as in the disclaimer type of arrangement, to me, that's a much better way to go. It just gives us the greatest deal of flexibility because we don't know what the law is going to look like in the future. We've seen a tremendous amount of change in the last dozen years or so, where we've gone from exemptions of $3.5 million to 0 to 5 million to 10 million and indexed for inflation. And so going all over the place. And in a couple of years, right back to the $5 million indexed for inflation. So we don't know. Would estate tax be repealed by that time? There's some politicians who say that they want to do that. Would we have a bigger basic exclusion amount? There's some politicians who say we want to do that. Keep that number growing up or even eliminate the estate tax. Have the small basic exclusion amount. Does it go down just according to the current exemption, right? Where it's going to go back down to 5 million index for inflation or closer to the Democratic Party's platform, which says to go down to 3.5 million, basically the 2009 numbers. And that means the estate tax would also go up to 45%. They use the 2009 as a model for that before we got this new 2011 tax law that came into place. You can also use the DSU if you want to, and you can anticipate future negative changes in the estate tax law. That means at the latest point, after the death of the first spouse, when filing the estate tax return, we'd be able to make the best decisions for them at that time. Again, not changing anything about who the beneficiaries are, simply making the best tax elections available to the arrangement. Irrevocable trusts in general have advantages. Just the fact that their money is in a trust means that somebody is looking over the expenditure of it. You can have language in there to that effect where we can control excessive expenditure by beneficiaries, being taken advantage of by suitors or family. This is a very common problem because people are living longer and longer. Medical care is getting better. Our brain doesn't always come along for the ride. And so elder abuse and elder financial abuse is quite a common arrangement. Creditor protection, of course, asset protection, even divorce protection. A lot of people are concerned about leaving money directly to their kids and then getting divorced with a 50% divorce rate, that half the money that they inherit basically goes away. And control over the ultimate disposition, where those assets go, especially in complicated family situations. That can really be important. So this is my little map of how a single Q-tip trust would play out, the series of decisions that get made in the order in which those decisions should be made. Because the federal tax is the largest, I would start with federal estate tax exemption and make a splitting choice based on that, right? Basically, that's the portability or bypass choice that you're going to make. Secondly, if you have a state level estate tax, to know whether to split that federal one. Again, most state estate taxes have a smaller exemption amount than the federal tax does. And then finally, to make generation skipping transfer tax exemption. The way I draw it here, start from the left-hand side, move to the right-hand side, and start covering each of the trusts until you run out of money. And if you need to split on the last one, then you can do a split on those trusts as well. Obviously, that is a job for professionals who understand how the tax laws work and what kind of exemption choices that they can make in that area, but it's very, very important. These are just the rules I put in here for reference in the materials. For electing portability, as I said, it has to be on a timely filed 706 estate tax return. You can't ever have two DSUs at once, but you can use more than one DSU by gifting assets away during life. Easy to say. You have to have a lot of money to be able to do that, however. And frankly, from a fiduciary standpoint, there could be a fiduciary liability for failing to elect the DSU. After all, I'm in a fiduciary capacity, and it's my job to act in the best interests of the beneficiaries. And so making sure that these choices are being done correctly. I've seen situations already where a family member was named as the executor or trustee when the first spouse died, and then when the second spouse died, it fell to a professional executor who, looking back, would have wanted to make the exemption election at the first death, but the person who was in that position just realized, the estate's not large enough. I don't have to make I don't have to file an estate tax return. And by not filing the estate tax return, they didn't make the election for portability. So the second executor basically gets stuck with the decision of the first executor. Very, very important to understand that we need to be able to be educated in these areas, to be able to make good decisions about that, work with professional partners who can help us to do that. So we do need to think ahead. We have to think about where the law is going, right? Sort of like the hockey analogy that some people use, where you have to skate where the puck is going, right? Not to the puck itself. Decide whether to use portability or to give yourself some flexibility with that area. Make sure to discuss these items with clients, with centers of influence, right? Not just directly with clients, but what are the centers of influence? What are the attorneys who are drafting the documents suggesting? What techniques are they using in the area? And talk about some of the pros and cons of what might be appropriate given a particular client situation. And of course, I talked about some of the second marriage situations or non-citizen situations. So be aware for traps of the unwary. The law, no matter how generous and simple it looks sometimes, is more complicated than it would otherwise end up being. So thank you for your attention in this area, and I'll stay around if you have other questions. Double check the chat. All right, I don't see other questions that are out there. The material should be available to you directly from the National Advisors Trust Company. Thank you so much for joining us today.
Hello, everyone. Thank you for joining us today for another Trust Education webinar. My name is Kurt Kohler, and I'm a trust consultant here at National Advisors Trust Company. Today's presentation is titled Special Needs Trusts, Planning for Individuals with Disabilities, and is presented by the Executive Vice President and Director of Personal Trust for Cannon Financial Institute, Daniel Smith. During the presentation today, please feel free to submit any questions you have via the chat box. You can simply click on the icon at the bottom of this meeting window that says chat, and the chat box will pop up on the right side of your screen. Daniel will address any questions you have as you submit them. Please also make sure that your line is muted during the presentation. You can find this function on the bottom left-hand side of your Zoom window. A final note before we begin: following the webinar, you will receive an email that will instruct you on how to file your CE credits for attending today's Trust Education webinar. That email will also include a PDF of today's presentation slides. So again, thank you for joining today. I hope you enjoyed the presentation. And with that, I will now hand it over to Daniel.
Thank you, Kurt. Glad to be with you all again. We're talking today about a particular type of irrevocable trust, a specific type of complex irrevocable trust called a special needs trust, or sometimes a supplemental needs trust. And it's really important to understand that, and we'll review this concept, that this is basically the same kind of trust that we've been creating as a bypass trust or a dynasty trust or whatever else. It's going to have very specific language in it with regard to how distributions can be made. Basically a very restrictive, ascertainable standard defined in the trust, and that's really one of the key things that makes special needs trusts do what they do. Several different ways to get into them. Certainly we don't need to be the experts on all the ins and outs and details. That's why we depend on people who administer these things for a living to understand all the ins and outs, a lot of which are related to state law issues. And so that differs from state to state. I have a hard time answering questions about that because the rules differ from one state to another. But the concepts behind special needs trusts are very consistent. One of the big things we want to separate between is whether it's a first party or a third party special needs trust. So just looking at sort of our objectives overall, obviously there's a lot of people who can't take care of themselves or protect themselves and therefore need to be the subjects of planning. This might take place in a proactive way, either by the courts or by the client themselves or by the client family. Generally, it's going to be one of those three groups that is operating in this manner. So very important whether those issues are things that we knew were going to be an issue in our planning or whether they're things that have come up as a result of an accident or injury or something else that has happened along the way. Sometimes we even want to morph an existing trust into a special needs trust, and we can talk a little bit about how to do that as well. So again, first party versus third party trusts. We'll talk about basically first party means I created it for myself. Third party means somebody else created it for me. We'll talk some also about examples of appropriate expenditures. Obviously, this is an area where there's differences in some of the state and federal law programs that are out there. And these are things that people who specialize in administering these things are very cognizant of. I've got a substantial list included in the materials of things that we know are safe distributions with regard to the plan itself. We'll talk a little about the clawback rules, which basically apply to first-party trusts as opposed to third-party trusts, and also, as I said, modifying existing arrangements sometimes so that they meet the standards necessary to do this. It's one of the substantial uses that I've seen of decanting, moving money from one trust into another trust so that trust has different distribution provisions or other aspects to it that drive the process. So just to understand how big this area is, the American Community Survey estimates the overall rate of people with disabilities in the U.S. population is about 13.2% in 2019. Obviously, it takes a while to compile some of those statistics. The percentage of people with disabilities in the U.S. Rose over the last 10 years from 12.7 to 13.2. So this appears to be an increasing element of the population, and as a result has driven a great deal of interest in the area of special needs trusts. Also, their complexity really drives, I think, a desire for people to have these in the hands of professional trustees, people who can keep up with the rules and who specialize in these areas, because for the individual population to understand, number one, they might have family members, there might be conflicts of interest associated with that wouldn't otherwise apply, because the way the expenditures are made, those expenditures can not only benefit the individual, but sometimes inadvertently benefit the family themselves. And so these are things that we want to be careful with regard to these types of trusts. Also in the U.S., rates of disability increase, obviously, with age. So for people who are substantially older, the same kind of group that would be at highest risk of COVID and other things we've seen recently, this is going to be 33.8%. Once you get to age 65, there's about a 50% or greater chance that you'll have at least 6 months of disability somewhere before someone passes away. But look at 18 to 64. We're still talking about 10% of the population. That's a substantial portion of the population that needs to have some kind of protection associated with this. And by the way, I've tried to add sources in all these things so that these are areas that you can go to and keep up with on your own as numbers change over time, if it's an area that you're working in with people. But, planning for people who have families that involve someone who needs some kind of financial care is an area that has existed for a long, long time. The rules have gotten more specific, and I think we're getting a better idea of exactly how to operate within these spaces, within the planning structures that are trusts. I was involved in a lot of these that were actually created by the courts, because there would be an accident and there would be a lawsuit as a result of it, and there would be a finding and a judgment of a lot of money. And the last thing in the world the judge wanted to do was to put that money into the hands of a family directly who was caring for that child, but who could also misuse that money. That is to say, they're not all necessarily families who come from high educations or dealing with large amounts of finances, and so the conflicts of interest can be substantial. We've seen that even with kids who are excel at sports. Take the positive side of that. People who are doing really, really well in life, or successful childhood actors or things like that, and their parents naturally, as their natural guardians, manage their funds. And sometimes that leads to potentially disastrous results because the conflicts of interest that come up involved with that, and the fact that the parents aren't necessarily financial financially trained, and so they don't necessarily know what's right and what's wrong. They're often doing what they think is right. There's great rationalizations along with that, but we can look back at some of those things and realize that they were fairly abusive in terms of the way that they operated. And so this is one of the reasons why working with a neutral party can be a really important part of that process, so that you really have that neutrality in looking at what's going on and making sure that we're acting in the best interests of the individual who is involved. So obviously this doesn't only affect the disabled individual themselves, but also their caregivers. Payments for things that people are doing and their caregivers, again, are often family members who are involved in the process. So, the current needs of the loved one have to be taken into account, but to the extent possible, the changing benefit landscape, service delivery in which that individual in the community is taken care of, we want to make sure that the money is used in the most appropriate fashion. In 1993, OBRA is a tax act back in those days. Congress allowed for the creation and funding of a class of trusts. So there are, instead of just individually crafted trusts, you can have pooled trusts. You can have what we typically refer to as special needs or supplemental needs trust, qualified income trusts. There's different structures that can be created with this. You've probably heard of ABLE accounts. Each of those things can be obviously discussions in and of themselves. We want to talk about the broad overarching method in which these things work. But this allowed for the creation and funding of these trusts without adversely, that should L in there, affecting the Medicaid eligibility of the beneficiary. Medicaid, of course, is the safety net program that the U.S. government has in place, that if somebody is financially challenged, that they have a safety net to be able to go to. So it's essentially part of the welfare system in terms of taking care of that individual. So the debate comes up when an individual has their own money, to what extent should this Medicaid system be playing in? Because, of course, Medicaid doesn't pay for everything. And so it pays for essentially medical services and the things surrounding what the needs of that individual are. But those needs aren't necessarily what you and I would consider to be all the life needs of that individual. So supplemental needs trust or special needs trust is a discretionary trust. So it's always going to be a complex style trust. We don't ever want all the income automatically to pay out to the individual. It's always going to be a discretionary trust to provide, obviously, for a disabled individual with benefits that are not otherwise provided for by government benefits. And that's the key thing. That's the key differential here between other types of irrevocable trusts that are complex trusts trying to take care of family members in the same way. They can have very broad descriptive terms in terms of how things are to be paid out, whereas the language in a special needs trust is generally kind of very specific language. For instance, the trustee shall not make any distributions from this trust that would disqualify the beneficiary for state or federal aid program. So you can imagine we're very, very careful in terms of what the distributions are, how the distributions are made. In all irrevocable trusts, that's an important component, but here you're actually talking about the potential for disqualification from other kinds of benefits. And so it's a really, really important thing to make sure you understand and get right. Whereas if I over-distributed from another kind of trust, I can cut back in other ways. I can change my distributions in the future. Those are things that are not going to punish us in some other manner or disconnect the value of the trust itself. So generally, the principal is protected and therefore not counted as an available resource for eligibility purposes. For these purposes, if the trust is set up in a way that is deemed to be a special needs or supplemental needs trust, then that's not deemed to be the individual's assets. We'll talk about the clawback feature later on. The beneficiary can continue to receive SSI, Medicaid, or other state, federal, local programs without any interruption, even though there may be an additional resource available to them through the auspices of the trust itself. So essentially, there are two different types of special needs trusts. And one of the key things for us to be able to understand about this is what is the source of the money, right? Where is the money coming from? Is it coming from the individual themselves? So if I have a self-settled special needs trust, self-settled meaning it's my money and I'm setting up the trust for my benefit. So for example, I become incapacitated tomorrow. I have some sort of an accident. I have some assets built up already in my own name, retirement assets and individual savings and those kinds of things. To what extent can I protect those assets from being used for my medical care and treatment versus utilizing the Medicaid program to do that? Obviously, those assets sit in my individual name. Naturally, they are resources available to me, and therefore those assets will disqualify me from any kind of welfare program that would otherwise be out there. So I can take those assets and put those assets into a trust to provide for my supplemental needs and still be eligible for the program. Talk a little bit more about this as we go along. But this is where the government does want to reach back and say, all right, so if we paid for a lot of the services that you had available and you had other resources available, granted you want to use them for other types of purposes, when that person passes away, basically the state's going to say, we paid that money out for your care. We would like to get that money back to the extent there are still assets inside of that trust. Okay, so this is what we refer to as a first-party trust or self-settled special needs trust. The second part is a third-party special needs trust. This is where my parents recognize that Daniel, doesn't really have the capability to manage his stuff himself, and therefore we're going to make sure not to enrich him in the first place. We're going to set those assets aside, not give them directly to Daniel, but instead put them into a special irrevocable trust for benefit of Daniel, right? And so this is where we're going to get our great separation, the tax protection, asset protection line between those two individuals, and we're going to set up a third-party special needs trust. So this is where the concepts that we've talked about before in many of the classes that we've been in, the various kinds of trusts that come out there, all play into the process, and you get essentially the same effect, right? We're not leaving the money to the beneficiary, we're leaving it for benefit of the beneficiary in this irrevocable trust arrangement. So that's incumbent upon us as advisors, obviously, to collect information that will be valuable to the people doing the planning or structuring the arrangements to understand what are some of the key things that play into this arrangement. So let's talk about what some of those factors are. Obviously, we need to know about the person and their relationship and their age, right? The relationships of the different parties who are involved in this arrangement. And people aren't always really forthcoming about this. I think a lot of people are not fully aware, especially in a lot of wealthy families that I've worked with. They have the ability to pay for themselves, and so they often just pay the bills. And that's an absolutely fine way to do it. If you ever saw the movie Rain Man, that's essentially what his father did. Rather than having the child live in some kind of a welfare state through a Medicaid type of program, he left his money to the institution in which his child would presumably always be housed. So from a functional standpoint, if you have the ability to pay for yourself and you're perfectly willing to do that, I don't need to go through the rigmarole of doing this. But a lot of people are not aware that even if I'm from a wealthy family, I may have the ability to set that money aside in a way that it can provide supplementally for those needs, right? Most people have unlimited amounts of resources to be able to pay those things. And so the fear is that my other money will run down, the welfare programs will kick in, but it will only pay for the minimum benefit that the state actually provides. And so we'll talk about some of the other kinds of things that can be paid for in this and why this is such a good idea to be able to put in place. And so that's why we really have to understand what are the relationships between the parties involved. That oftentimes doesn't come up directly in conversations, and so you have to listen for clues when you're talking about stuff. So, I like to use family groupings and individuals, and, when they say they have kids, and I say, great, how many kids do you have? And usually the way I'll do this is I'll simply put it into context. So let's just take a really simple example and say that my client has a net worth of about $4 million. And I know that they have 4 children. It's important to keep this in context so that it doesn't seem weird to them where you are dollar-wise. So if I'm going through a conversation with them, gathering up information, updating their assets and where they are, I say, great, we have a net worth of about $4 million. And you have to tell me about your estate plan. Their estate plan leaves things equally to the kids, for instance. And so you can say, So tell me, if you gave each of your kids $1 million tomorrow, what would they do with it? This is what a lot of people's estate plans essentially do, right? They simply distribute the money outright to each of their kids. And so I like to ask that question or directly in that way because it's an indirect way of getting the feedback. They'll generally answer child by child. Well, my oldest child, he'll probably have it spent within 2 weeks. Now my daughter is the second one, and she'll have every buck of that saved and be earning interest on that going forward. My third will probably speculate like crazy, and who knows whether he'll make money or not make money on that. And my fourth really he doesn't have the ability to manage that money himself. Some kind of information is going to come out. They won't necessarily...
Brianna, this is Patricia Kummer, Kummer, returning your call to schedule an appointment for an ultrasound from Roger Merkin over at Panorama was the referral. So if you could please call me back so we can schedule that, I'd appreciate it. 303-909-4091. Again, 303-909-4091. Thank you.
Thanks, Patricia. Might want to find that mute button, just a suggestion. All right, so from there, that's where you oftentimes get information flowing out from the client that is going to give you some indication that there is some kind of a family issue, that somebody is unable to manage money directly themselves. Again, people don't just lay that out on the table necessarily. Sometimes you have to draw it out from them, and so it's an important thing to take a look at. And so from there, you say, well, tell me a little bit more about that. Well, Daniel was born with a developmental disability or something like that, and trying to figure out what kind of disability that it is. Is it developmental? Is it physical? Is it mental? Is it just medical care? Oftentimes people have complete capabilities to process information, but they need help with other kinds of medical care. And so the key thing I'm trying to figure out is the child involved in the process? Do they understand what's going on? Can they be a participant in that process? Or are they somebody who needs to be taken care of completely? And so those kinds of things can certainly affect the structure and the way that the structure gets set up in the first place. And then also just thinking about what is it that precipitated the meeting? Why are we having this conversation in the first place? Obviously, that's one thing that I try to initiate with other clients. But oftentimes I get young couples coming in, and anytime a young couple especially is asking about estate planning is one of the first things that they're keyed in on. I always ask, what is it that made that come to mind for you? Oftentimes it will be a death in the family or some kind of a dramatic event that they have experienced recently themselves. I remember talking to one couple, and they said, I think it was the woman said she was driving down the highway at full speed, and suddenly, as if she had slammed on the brakes, but she said she didn't, at full speed, at full highway speed, the entire car locked up and spun around on the freeway, where all the other cars, of course, were at full speed straight at her. And she realized, this stuff could happen to you at any time, and I better have some kind of plan in place. And so just kind of understanding what that is, whether this is one of the key reasons for the meeting, the fact that they have a special needs child and they wanted to talk about that will usually come up, obviously, in your setup to the meetings, or whether this is just kind of a background element. Well, again, a lot of people don't know how to bring that up or even know that there are special issues that can be addressed within that arrangement. You also want to identify whether there is a litigation or settlement position that is taking place. In other words, was there a lawsuit? And as a result of that lawsuit, there is money coming available to a child, and they're trying to figure out how to deal with that. In the same way that a lottery winner in a surprise manner, winning the lottery, needs to do a lot of financial planning to try to figure out what am I going to do with this money? How's the best way to protect it? How should I invest it? How should I take care of those things? My child may have been through a difficult situation, or I might have been through a difficult situation or an accident, and there may be someone at fault. And as a result, we're going through a lawsuit. Initially, I don't know whether there's going to be a finding of fault or not, but now as we're sort of winding our way through the process and talking about settlement agreements, we've got to figure out what is the result of this and who is the money coming to and what are the reasons for the remuneration that's taking place. Is that to the individual? Is it to the family for what they've experienced? Those components of it are important with regard to who is the owner of the underlying funds. And then we have to get into a little bit the government benefits. What government benefits are currently available to those individuals? Again, you don't need to be an expert in the area and understand all the individual pieces, but what kinds of things are we looking at here? We're looking at Medicaid and the services that can be provided in a situation like that. We're looking at residence, a group home, or care facilities. They can just stay at home. How are the manners of residents going to be addressed? And then education or work. They have supported employment, is there sheltered employment or developmental training that people are handling. I've got special needs situations in my own family. My younger brother is very high functioning. When he was young, we didn't know that he would be able to operate on his own and hold a job, but he's married and has a job and is fully employed in the regular workforce. That was not an easy climb necessarily for him to go through, but from a functional standpoint, he was able to work his way out of the issues that he had and develop a level of education necessary to do work and participate regularly in society. I have a niece, however, that will never grow out of the condition that she's in, and so she has supported employment. She has the ability to do some things, but not in a way that's going to be able to be supportive of her. But nonetheless, activities, social interaction, work interaction, keeping busy both physically and mentally, those things can be really, really important. So kind of understanding what does their situation look like in that way. Those are important things to explore as well from people who are involved. If they haven't looked at that so far, just exploring a little bit of what they would expect along those lines. And then from a financial support standpoint, where does the family
This Creditors in Commerce classroom session, hereinafter session, is the private exchange of ideas and concepts between the providers and the recipients. The content is not meant as legal advice. The use or attempted use of any idea or procedure discussed in this session as applied to the recipients.
Also the work of the individual. So as we were talking about before, if they're able to work some and provide some for their own financial care, obviously that's money, first-party money of that individual's work that they're doing themselves. That is money they might be able to put into a special needs or supplemental needs trust, or that would just cut down the amount of benefits, count towards the benefits that they're receiving from the state or federal government, and then what government programs might be available to them. Again, both at the state and federal level can be quite layered, and the rules are different from a state-to-state basis. But in a lot of cases, they may require a special needs trust, especially if funding is being made available to that individual. Again, if I got into an accident today, right, I'm later on in life, I've built up some assets on my own. The question is, how would we best protect those assets that are there, as opposed to I'm thinking about a minor child, I'm thinking about somebody who's under my care, and I'm trying to figure out when I pass away, what's going to happen? How do I continue that care without that money simply being drawn away purely to medical care that can be quite expensive and no longer be available for other kinds of supplemental needs of that individual. So as we look at estate planning options for a special needs family, let's just talk about some of the key elements that are here. Number one, distributing assets outright to the individual with a special needs child. This is not something that you necessarily want to do, since the assets may disqualify the child from receiving means-tested government benefits. It is really important that when this is recognized within a family unit, that you create the proper asset protection arrangements to be able to do this. So even a grandparent leaving money to the children, where those individuals have a special needs child, that's something you might want to instead look at putting it into an irrevocable trust instead for benefit of those parties, so that we keep it behind the asset protection wall. Disinheriting the special needs child, right? This is generally not recommended, since the child will have no safety net if the government benefits are subsequently reduced or eliminated, right? Some people just say, well, Daniel is subject to state or federal aid programs, and so we just won't leave him any money, right? If we got 4 kids, Daniel's would simply go to the government essentially, and so we're just going to disinherit him from the assets that would be passing down within the family tree. The problem with that is all you have now is the government benefits available to that child. Now, you might get promises and willingness of other parties to be able to support that, but now you have hope rather than a plan. And so it's really important to understand what level of planning you want to engage in to ensure that that child is taken care of, properly taken care of, structures are put in place to be able to take care of them in a way that those assets are available to the child, but not necessarily going to disqualify them from the government benefits that would be otherwise available. Third thing is you could leave property to another family member with the understanding, right, the quotes in here, this is the hope as opposed to plan side of things, that the property be used for the benefit of the special needs child. So it's sort of a moral trust or an honorary trust. Again, generally not recommended since the arrangement isn't legally enforceable. And the creditors of the family member, including ex-spouses, somebody could get divorced or those kinds of things that could have substantial implications, or if I were to get involved in other kinds of legal issues, I was drunk driving or something like that, had an accident, those are my assets. And so if I'm the caretaker and I'm the person who's supposedly going to be using my assets for somebody else, those assets are subject to the creditors of the caretaker inside of that arrangement. Of course, you don't have that problem when you're dealing with an irrevocable trust instead. So very important to make sure that those assets are protected in the manner in which the family feels most comfortable. Number 4, you could establish a third-party discretionary support trust for the individual with special needs. This is something to be careful of, right? Generally not recommended since the trust will, in many states, disqualify the child from mean-tested government benefits. If I just have an irrevocable trust for benefit of the child, right? Just a regular discretionary support trust, not a special needs trust, but just one that says pay so much or all of the income and or principal to my child or children, my descendants, right? Standard language that we see in the trust and estate planning world. So what we think of normally as a bypass trust or a dynasty trust type of setup, where we're using something that has an ascertainable standard language in it, the typical language that we might see like health, maintenance, or support, right? The kind of language that is typical in the trust world to use. May be perceived by the government and the courts as being so generous as to being available to the child, right? Even if not owned by the child, but nonetheless under those clauses, if it says health, for instance, or maintenance and support, for instance, that those assets would be deemed to be assets available to the child and therefore disqualifying. So this is where, let's just call this a normal irrevocable trust might sound like it's the panacea for things. And in fact, that might be the normal part of my estate plan that was set up when I don't know that there's going to be a special needs issue with regard to a family member downstream, a child, a grandchild, et cetera. And this is where we might want to morph or decant this trust or modify this trust so that it complies with the special needs rules. So number 5, establishing a third-party created and funded special needs trust for the individual with the special needs. This is really the direction that you want to go, since the trust will not disqualify the child from receiving means-tested government benefits, right? It has to have specific language in there. Is going to be identified in that way. So when we have very broad ascertainable standard language as the trustee deems appropriate, or Health Education's Board of Maintenance, or in their accustomed manner of living, right? Language is very typical in the irrevocable trust world and normally serves as a barrier to entry to creditors and other types of parties. But it's not going to protect me if it says that it's to pay for my health. And sure enough, these are healthcare services that I'm receiving. And the government's going to say, we're not going to pay. Obviously, they don't want to pay for anybody who can pay for themselves. And so this is a really, really important balance to strike inside of this arrangement, and to realize that sometimes that irrevocable trust that is created with all good intentions and is proper planning in a regular family situation, you might want to take number 4 and decant it or modify it so that it becomes a number 5. Again, this is a very specific methodology in the trust world to be able to take essentially the contents of one trust, put it into a context that most of us can understand, and decant that into another trust, right? So if I've got a bottle of red wine here and I pour it down into my decanter, then I've changed the structure, but not so much the content. In the process of doing that, I can also sometimes change the beneficial language inside of that arrangement. The legal context here is that if I can distribute from the trust, right, if the distribution language allows me to distribute to Daniel, right, for my health, education, support, and maintenance, for my custom manner of living, for whatever the language is in the trust, as the trustee deems appropriate, then presumably I can distribute to Daniel in a lesser form. That is to say, into a trust for benefit of Daniel that has more restrictive language than before. Again, in fiduciary capacity, I have to be able to identify that I'm acting in the beneficiary's best interests. That's sometimes harder to do if you're just talking about Daniel as a regular person. But if you're talking about Daniel as a special needs person, now that starts making a whole lot of sense. And there are lots and lots of case law out there on decanting as a result of, let's say, a child reaching the age of 18 or 21 or 30 or whatever the trigger age is inside of the document, right? Very often I'll create a trust and I'll say, if my kids are under the age of 35, then hold the money in trust for their benefit. And when they turn age 35, give them their share of the trust. Well, so if I'm 34 and this trust pays outright to me at age 35, and it's clear at this point that I have developmental disabilities and I'm not going to be able to handle those assets on my own, then before the outright distribution takes place, before that trigger age occurs, it is important to get those assets from the irrevocable trust that is behind that asset protection firewall and put it into a trust that is protected because of the special needs rules in the code. Very, very important to understand the timing of that. Because if I get to age 35, then it's an outright distribution to me, right? I have full control of that. If we wait until that event takes place, it's going to mean that even if we do create a special needs trust, it's going to be a first-party trust instead of a third-party trust. It is better to create a third-party trust instead, right? And so a third-party trust is going to be the one that we can protect the most from this arrangement. So that decanting from one arrangement into another should take place in advance of lifetime general powers of appointment accruing or outright termination or distribution language taking place inside of the trust, right? It's an anticipatory arrangement. So when, again, you have family members who have issues asking about, are there trusts that have been set up by the parents or grandparents or other parties for benefit of that child? And so that we're anticipating those periods where that money would become available to the child outright, and therefore would be the child creating the structure effectively rather than the parents creating the structure. Even if the parents are doing it as guardian of the child, right? They're doing it on the child's behalf with the child's own money, and therefore it's a first-party structure instead of a third-party structure. So that's really the direction that we want to go inside of those arrangements, even though the regular planning that we've talked about is a good idea, and I don't necessarily have to have every alleyway created. I do see sometimes that there will be specific language inside of the trust that says if any beneficiary is not able to handle the trust, then the trustee has the ability to, or it will define a separate route to go down if child's unable to handle the assets on their own, or they'd be subject to state or federal aid programs or disqualified from state or federal aid programs, then distribute the money as follows, and it will go down a different route and create a special needs trust within that arrangement. Not necessarily default language, right? Because when people don't have those situations in their family, they're not necessarily anticipating those situations within their family. So very, very important to understand the balance of that, and that what is sometimes normal, very good planning may not work in a context like this. We'd rather not have to go through the decanting process. We'd rather not have to go through the state modification of arrangements in order to make that happen. When you can anticipate that in advance, that's usually the best way to be able to take care of the arrangement. All right, let's clean up our wine glasses here and take a little bit of a look at the two different kinds of special needs trusts that we'll focus on here and how to identify what type of trust is appropriate. So the key question is, whose money is it, right? Is it the child's money? Is it the subject, let's say, of the assets, or is it another? Okay, this is where it's a third party arrangement. Okay, if it's the subject themselves, it's a first party arrangement. And then what is the source of the funds? Is it inheritance? Is it outright? Is it in trust? Can we get to it before it actually makes that distribution? Or is it some kind of a personal injury or medical malpractice type of arrangement? Sometimes they refer to that as med mal. Nobody can actually say the entire word. That would just be working too hard in a society where we have to do everything in less than 140 characters. Right, so medical malpractice situations or personal injury situations where it's coming from some other third party. Again, I would want to, the judge should anticipate that and help you to set up the most appropriate arrangement for the beneficiaries, but sometimes the family will have to encourage that to make sure that it's set up from the beginning